total of 48 cents in my CPF. Not my proudest day, no. I grew up feeling quite financially insecure. I was saving as much as possible, trying to get any job I could possibly find, just to give myself that sense of security. I had a problem spending money, even when I was earning more money. Downsides to being a freelancer, of course, would be security and stability. You don't know when the next paycheck is going to come by or how big that paycheck is going to be. The Endowus app is very easy to access. It very quickly shows me the breakdown of the portfolios and exactly where my money is going. When I was trying to map out exactly what my financial goals were, I sat down with my financial advisor from Endowus, and she was the one that kind of walked me through this process. It's a very calculated way of determining how I can reach the different goals that I had in mind. It feel more confident about putting my money down and investing with Endowus. Now, I am thinking of a much bigger picture. What am I saving for? And what goals am I working towards? When I think about what my future may look like, the kind of adventures that I want to go on, people that I'm going to meet, just the ability to dream beyond my present life.
That's a deep question. You start with that?
Why you gotta ask me hard questions like this, sir?
I'm very much focused on running the business.
We wake up thinking about business, we go to sleep thinking about business.
You don't know when the next paycheck is going to come by or how big that paycheck is gonna be.
End of the day, it's hard-earned money, so you need to know where you're putting your funds in, not just go with the flow.
When it comes to investing, I do find it a little bit tricky because I don't have any finance training or any finance background.
I am a first-time investor, and I like knowing that I'm in fairly safe hands. I have an advisor here who actually has my best interests at heart, and that's how it feels.
Being on a platform like Endowus, I can kind of set it and forget it and leave it in the hands of the experts.
It's one of the platforms that really gives me full control.
Very seamless, very easy to use.
Not even having to worry about what my money is doing and freeing up my time and my mind space to be able to do the things that I really want to do.
grew up feeling quite financially insecure. I was saving as much as possible, trying to get any job I could possibly find, just to give myself that sense of security. I had a problem spending money, even when I was earning more money. Downsides to being a freelancer, of course, would be security and stability. You don't know when the next paycheck is going to come by or how big that paycheck is going to be. The Endowus app is very easy to access. It very quickly shows me the breakdown of the portfolios and exactly where my money is going. When I was trying to map out exactly what my financial goals were, I sat down with my financial advisor from Endowus, and she was the one that kind of walked me through this process. It's a very calculated way of determining how I can reach the different goals that I had in mind. It made me feel more confident about putting my money down and investing with Endowus. Now, I am thinking of a much bigger picture. What am I saving for? And what goals am I working towards? When I think about what my future may look like, the kind of adventures that I want to go on, people that I'm going to meet, just the ability to dream beyond my present life.
Start with that?
Why you gotta ask me hard questions like this, sir?
I'm very much focused on running the business.
We wake up thinking about business, we go to sleep thinking about business.
You don't know when the next paycheck is going to come by or how big that paycheck is going to be.
End of the day, it's hard-earned money, so you need to know where you're putting your funds in, not just go with the flow.
When it comes to investing, I do find it a little bit tricky because I don't have any finance training or any finance background.
I am a first-time investor, and I like knowing that I'm in fairly safe hands. I have an advisor here who actually has my best interests at heart. That's how it feels.
Being on a platform like Endowus, I can kind of set it and forget it and leave it in the hands of the experts.
It's one of the platforms that really gives me full control.
Very seamless, very easy to use.
Not even having to worry about what my money is doing and freeing up my time and my mind space to be able to do the things that I really want to do.
Good afternoon, everybody. I know that you're still trying to find your seats. I'm going to just ask the last people who are in the doorway to please step into the room. Thank you. Ladies and gentlemen, a very, very warm welcome to the annual Endowus WealthTech Conference, where we'll be diving deep into the exciting world of wealth tech, the heart of innovation in finance. My name is Anita Kapoor, and I am a longtime television host, your host today. And if you've been watching the little film behind me, I'm also the answerer of very deep questions. It is my absolute pleasure to be here with you today to guide you through this event, and whether you're joining us in the room or whether you're joining us virtually, a big hello to our virtual audience as well. Thank you so much for being here today. Now today we're going to be delving into the important topics that are shaping the wealth tech landscape, from navigating the complexities of the high interest rate environment to uncovering the pivotal role of AI and deep tech in wealth management. We've got an agenda packed for you today, and we've put it right after lunch, so we're going to have all of your attention. I hope everybody's had a little bit of caffeine to give you a little bit of a boost so that we can keep you going. Now, we understand that you may have lots of burning questions for all of our panelists, or you may have thoughts, or you might have just, nice things that you'd like to say to us. So if I could invite you to head over to slido.com and use the event code EWC2023. I think it's up on the screens behind me, or it will be in a minute. We also have mics in the center of the room. That is not for a free-for-all karaoke. It is to ask your questions in person during the Q&A session, although karaoke would be fun, right? Come on, guys. It's Friday. And we'll have a Q&A section, so please feel free if you would like to address our panelists directly. And of course, we love when people share, and if you'd like to share, please do so on social media and use the hashtag EWC2023, or you can tag us at Endowus. Before we begin, a big thank you, of course, to all of our partners without whom today would not have been possible. Our platinum partners, Amundi, Dimensional, Franklin Templeton, feel free to clap if you'd like to, UBS Asset Management. Our gold partners, BlackRock, Neuberger Berman, Schroders, T. Rowe Price. And of course, our official knowledge partner for today and tomorrow, McKinsey & Company. Additionally, our heartfelt thanks to our supporting media partners, Singapore FinTech Association, Family Office Association Hong Kong, and FinTech Association of Hong Kong. Now, today's conference, as you know, come on in, guys. Don't hide at the back of the room. Come on in. We have plenty of seats. Just come in and fill up the seats, please. Thank you. Today's conference, as you know, is proudly presented by Endowus, and we will hear from our host in just a moment. But first, a little snippet of the Endowus journey. Please watch. Ladies and gentlemen, if you could please put your hands together and welcome today's host and CEO, Gregory Van, on stage to say a few words. Greg, if you would please.
Hi, everyone. Thank you so much for being here today. This is day one of our Endowus WealthTech Conference, the second year we're hosting the Endowus WealthTech Conference. And we think it's incredibly important that we are able to bring the entire industry along with us on this journey. Endowus was a concept that we founded, just over half a decade ago. It makes it sound longer, but it was about 6 years ago. And we came to market about 4 years ago to really transform the way we interact with our wealth. It was born out of a personal frustration to try and solve three things. helping us invest better to live better. And the gap we saw in the market was a lack of conflict-free, evidence-based advice, institutional access to financial products and solutions, and very, very importantly, because it hits our bottom line, a low fare fee to get us there. WealthTech is a solution, but what I want to be very, very clear about is that it's not about putting a digital wrapper on something. It's not about helping people trade faster, speculate more on options, earn more, payment for order flow or kickbacks or anything else of that sort. It's really about wealth and changing a business model and technology changing a service model. If we use technology to scale, we can lower our cost to serve, we can scale products to more people, we can scale intelligence to a much wider audience. And that's really what we've been focused on doing for the last few years. A lot of our partners are here today, and from the get-go, we've said Endowus is about proliferating conflict-free wealth management. By being conflict-free, we can act with independence and in deep partnership with many of you in the audience and in the financial industry around the world. We're very, very proud today to work with over 80 global fund managers, and this is across public markets, everything from cash management to fixed income to equities to real estate, et cetera, hedge funds, as well as private markets. Our team, which is very, very human, but of course using the best of technology, is there to curate strategies. I mean, there are millions of permutations of the way you could be deploying your wealth, but we're really there to help you, we're really there to narrow it down, act in a completely conflict-free and independent way to help you asset allocate across these strategies. And we think this is a very virtuous cycle because we remove a common problem in the industry, which we think is a negative selection bias, where perhaps products that are willing to pay more for distribution are the ones that get ultimately distributed. By having zero conflict of interest, we're able to really unlock the power of the asset management industry and get it into the hands of the end user. Also, as we've been through the last year, I mean, from a year ago till today, 1 million things have happened. We've seen a lot of fintechs actually disappear, unfortunately, largely because of misuse of their balance sheets. We've seen this happen to established players and banks as well. For those of you in the audience, there are slides on the two sides, not in the middle behind me. So if you're wondering what we're referring to here. But Endowus taking zero leverage, so we do not offer leverage. We may pass up business on that basis, but we don't think that's where we specialize. We don't use our balance sheet. We believe in one-to-one asset backing and really having secure asset custody. So our operations are completely segregated from Endowus. I think this is a really important point. It's one of the reasons why we also became the first digital advisor for CPF Money back at the end of 2019. As well, unlocking the power of advice, access, and cost is not about helping you speculate more. It's really about helping you organize your wealth and life. So you can run portfolios made of these best-in-class solutions designed towards specific goals you have in your life. In the asset management industry, we call this liabilities-driven asset allocation, strategic passive asset allocation. We really want to do this and make it possible for everyone, so we unlock endowment investing for all of us. It's been in our name since we were founded. It will be our mission for the next 10 years, 50 years, 100 years, and long after, we're maybe all just AI cyborgs of ourselves. And all of this combined, it's about creating security, personalization, unlocking peace of mind so that our clients can invest better to live better and actually unlock time for themselves so they can pursue things that matter most to them. Finally, we think if we are able to achieve this goal with all of you, there will be tremendous impact and progress, not only for clients, but for the industry and society. More and more of the world is moving towards conflict-free. We are just at the very start of that journey in Asia. It's been a revolution happening for the last 30, 40 years in Europe and Switzerland and Australia. We're just at the very beginning. We're at the cusp of this technological revolution as well, where we can really speed up the cycle. So thank you for everybody being here. And finally, change does take a global village. I mean, we had incredible sponsors today to make today possible. We continue to collaborate with the industry to make things possible. And we're here to serve. We'll love your help. We serve individuals, that's retail, high net worth across cash, CPF, and SRS. We serve family offices, that's through Endowus and a Endowus-owned company, Gregory in Hong Kong. We serve institutions, foundations, charities, and endowments, more and more so in Singapore today. And we do a lot of wealth education. I know many of you are here today because we've engaged your firms in educating people about their personal wealth management, because we think that if you can secure people's wealth, you're really helping them live better. Wealth is health. And we would love to work with all of you on this. There are tons of people from Endowus around today. Please approach any of us. We're here to collaborate, and we're here to spread knowledge. And I hope today you get something out of today's conference which enriches you in some way. So thank you very much. Oh.
Thank you very much, Greg. I just want to say, I am not coming back as an AI cyborg.
Okay.
Okay?
We may have to recreate you as
You're going to have to recreate me. But, you know, I wanted to come out here while they're... Let's move forward a little bit, because they're just rearranging the chairs for the panel discussion. Please do not fall off the stage either. Yeah. And please don't run away from me. Come a little closer, because, you know, the virtual audience need to look at us. So I'm actually I'm a first-time Endowus. Do you call us customers? Clients? I'm a client, you know. And I have to say that from the get-go, even just as on a personal level, what you've just said today, the things around about advice and access and cost, especially the advice from the get-go, I actually felt really comfortable with you guys. And I think that is the game changer, to be honest. There's everything else, there's technology around it, but just the comfort level.
Yeah, absolutely. And I think the reason why it felt maybe different from previous experiences is because we're not in the business of trying to push you a product as fast as possible.
Yeah.
The key is really trying to understand the client's needs and goals and views and matching that to investment solutions.
Yeah.
I mean, you know, it's very, very hard to time things just because you had coffee with a friend and they told you to buy some stock. You know, that works sometimes, but it actually doesn't work a lot of the time as well.
Yeah, because there's nobody else after that to tell you what to do.
So we think that having a very advisory-led experience of wealth is incredibly important.
I think so too. And I think what you said about the time, it's actually taking the time.
Absolutely. I tell this joke all the time. People spend more time trying to book a reservation for dinner on Saturday night than they do thinking about how to invest their hard-earned money. And first of all, we hope to make it a really pleasant experience, just like that dinner experience that you're after, but also to really understand the benefits of delayed gratification.
Book the call, then go out for dinner. How about that?
That's right. Sounds good.
Thank you very much, Greg. Thank you so much. Big round of applause, please. And ladies and gentlemen, we're going to go straight into our very first panel for today. Our esteemed speakers will be discussing how we should navigate the high interest rate environment on a longer term basis. And may I please welcome to the stage my moderator for this panel, Hugh Chung, Chief Investment Advisory Officer at Endowus, and as well as our speakers, Wen-Ting Shen, Solution Strategist and Portfolio Manager, T. Rowe Price, Alice Lowe, Head of Singapore Retail PIMCO, Hui Sin Kui, APAC Lead Indexed Fixed Income Product Strategist BlackRock, and Hilda Cheong, Investment Director, Fixed Income Schroders. Before I hand it over to you, Hugh, once again, if you have any questions for our panelists, Hugh holds in his hot hands the Slido. You do have that, right? Yes. So if you would like to send some questions over to this panel, please do it with the code EWC 2023. The sign-in details are also on the screen. Hugh, over to you.
Thank you. Hi, everyone. I'm so honored to be the first panel moderator for our second conference, which, as you can see, it's very, very high quality. I've been to a lot of conferences in my career, and this really tops the list, so thank you very much for coming. So today, my name is Hugh, Chief Investment Advisory Officer. I look after the investment office on a day-to-day basis. Today, we're going to discuss how to navigate the high interest rate environment on a long-term basis. I'm sure this is on the minds of a lot of investors right now. As of yesterday, the 10-year actually hit very, very close to 5%. I believe it was 4.99. Over the last 3 months, we've seen the 2-year and the 10-year really what we call bear steepen, I think more than 100 basis points. So a lot is happening in that space, and this subject is really the top of our minds. So without further ado, let me start by asking our panelists to maybe make a very quick 30-second introduction, maybe starting from Wen-Ting.
Sure. Hi, everyone. Really great to see the full house here. My name is Wen-Ting Shen. I am a multi-asset solution strategist and portfolio manager from T. Rowe Price. Excuse me. I was with BlackRock before. So I'm also part of the Asia Regional Investment Committee. So my job is really to design and manage, customize the mandate for our clients in the region, bring out the best of T. Rowe Price investment capabilities. And as I already sort of alluded to, I joined T. Rowe Price from BlackRock. I was with BlackRock for about 8 years before T. Rowe Price.
Thank you, Wen-Ting. Alice?
Hi everyone, very nice to be here. My name is Alice Low and I'm head of the Singapore retail business at PIMCO. My role primarily involves working with partners like Endowus to bring PIMCO's solutions and our thought leadership views to our end investors. I've been at PIMCO for about 7 years currently, and I have a total of about 17 years of experience.
Thank you. Hui Xian?
I'm Xian or Hui Xian. I'm responsible for BlackRock Asia Pacific's product strategy for fixed income, with a focus on just broad index anywhere in the world where we find opportunities for our clients. I spent half my BlackRock career, 4 years in the London office, and then 4 years moving closer back home, which has been the best decision ever. Reconnecting with ex-colleagues like Wen-Ting and many faces I see across the room actually. Looking forward to catching up. Like Gregory, I'm also very excited from what I can see happening already in the European space, and that wealth pivot to more bonds, more kind of institutional-like, more democratization of investing. I think that's why we're here.
Hi everyone, I'm Hilda. I'm the Asian Fixed Income Investment Director from Schroders. Joined Schroders about 2 years by now, and in total about more than 8 years of experience, mostly focused within the Asian credit space. So within Schroders, I kind of represent or front our Asian credit range in front of clients, and also mainly representing our portfolio managers in terms of their views, how they're positioned, and really just working with key partners like Endowus in expressing our views within this segment.
Thank you. I know we're very tight on time, so we're going to try to be really quick. Starting from Wen-Ting, you're a multi-asset solution strategist, so I'm sure you're familiar with equities and bonds. So in this high interest rate environment, what is your view on how to allocate between equities and bonds? And in particular, as we look into retirement, a lot of people are looking at the high returns you can get from cash-like products right now, money market funds. So what would be your kind of view on or recommendation on how you asset allocate during this environment?
That's a very spot-on questions. I think it's relevant to all of us. And I'll break down the question into the two parts. I'll talk about the asset allocation between equities and bonds first, and then I'll talk a little bit about the choice of money market funds for retirement savings purposes. So yes, we are having high interest rates right now, and understandably, it is a concern for many investors. But we shouldn't be bearish just because the interest rates are high. And if you look at the history, a lot of the times we had the Fed funds rate above 5%, but the market still has plenty of life to go. And just because the interest rates are high doesn't mean it will suck the oxygen out of the system. And in fact, yes, we are probably at the highest interest rate environment since the global financial crisis. But looking back into the history of capital markets, there were decades that had interest rates higher than 5%. This year, a lot of people are getting excited about AI. And if the market continues to be excited about the productivity gain from AI, then the market could go even higher. So going directly to the asset allocation decisions between equities and bond, let me give you our conclusion first. So in our multi-asset portfolios, we maintain a modest underweight position in equities and have an overweight position to bonds and bonds and cash. But here is a twist. We actually think Q4 could be a window for risk assets to do well, with a combination of resilient US economy, our historically strong seasonal period, and also a potential rebound in investor confidence, given that there could be potentially a change of global monetary policy trajectory. So that seems to have a disconnect between our views and our positions, and let me explain why. We actually think high yield could be a very attractive alternative to equity in any multi-asset portfolios. Historically, high yield has shown high correlation to equities, but it definitely has a significant yield advantage to equities at the moment. To top it up, the default rate, even though it has increased, but is still low relative to the long-term average. So as a result, we hold a overweight position to high yield and underweight position to equities, but from the equity beta perspective, we are neutral. So going into 2024, even though probably in the short term, the economy is still going to be resilient, but we think the uncertainties will only go up from here. The market pricing currently reflects a softer lending scenario, but that sets us up into an asymmetry into 2024. If we ended up with a softer landing, great, but it's already reflected in the pricing. If we ended up with a hard landing, guess what? It's not reflected in the pricing. The fading of fiscal stimulus and policies effect could start to show even more next year. So as a result, our position is that it's not a time to be a hero. And in our multi-asset portfolios, we're not taking large active positions because of the heightened risk and the wide range of possible outcomes. Then going to your second part of the question about retirement, I can totally relate to those investors who think that putting your hard-earned money, particularly for retirement, into money market funds is great because it's risk-free. But having said that, Hugh, let me ask you a question. If I tell you the expected return for cash over the next 5 years is 3.9%, but the expected returns for global equities is as high as 9.4%, would you still be happy to stay in money market funds and give up the upside in global equities?
I think you know what my answer is. No.
Yes, but you might be asking me a question. Oh, how about I enjoy the high risk-free rate for now, and when the interest rate comes down, then we'll switch out.
Yep.
Fair enough. But there are numerous studies that have shown that market timing is notoriously difficult. And if you look at the behavior pattern of individual investors, they tend to buy high and sell low, the exact opposite of what we should be doing. And in fact, on this exact topic, the Department of Labor in the US has concluded long ago that money market funds are not qualified as default options for defined contribution schemes in the US because over long term, cash or cash equivalent principal guaranteed products, or you name it, they are not going to be able to produce as favorable of rate of returns as other qualified investment products, such as target date funds. And that will decrease investors' likelihood to save enough for their retirement over time.
Yep. No, thank you so much, Wen-Ting. With that related question, I'm actually going to go to Alice. It is a related question in the sense that in this environment, risk-free returns are 4 to 5%. A lot of the kind of safer bonds are giving you only maybe 1 to 2% higher returns. So from a perspective of PIMCO, how do you think about that? How does it justify going into these bonds? And in particular, I think PIMCO is also very much into structured credit. Is there a difference between corporate and structured credit risk reward in your view?
All right, thanks, Hugh. So if I can rephrase the question slightly, I think the first part of the question is asking why should investors consider bonds over cash right now? Yep. So on that question, I think there are 3 key reasons why investors should consider bonds over cash. Number one, obviously, is the yield advantage. You just mentioned earlier that bonds are out-yielding cash, risk-free assets right now, albeit 1 to 2 percentage points higher, but it's still higher nonetheless. And historical data has shown that there is actually a 94% correlation between the starting yields in bond markets and the expected forward returns. So the high yields that you're experiencing in bond markets right now actually bodes very well in terms of expected returns for bond investors from here on out. And then number 2 is that you also give up the upside when you're staying in cash versus bonds. So there is no capital risk per se, but there is reinvestment risk for cash. If you look at currently what the markets are pricing in right now, markets are pricing in the Fed to start cutting rates in Q2, Q3 next year. So you do expect that rates will start falling. And if you are in cash right now, there is actually reinvestment risk. If you put a 6 months fixed deposit, when the fixed deposit matures, high chance that you can't roll it into another fixed deposit at current rates. Versus bonds, where if rates starts coming down, then there's capital gains that can be made in the bond markets. Now, of course, one key question that Wen-Ting also talked about is market timing. A lot of clients may ask, why don't we just wait until the Fed is done with the rate hikes and then we start to enter the bond markets? But again, we've actually surveyed historical data. If history is any guide, if you look at data going back to the 1970s, and we survey rate hike cycles across developed markets, we've actually noticed that as early as 1 to 2 quarters before the peak rate hikes, in the rate hike cycle, bonds actually start to outperform cash on a 1-year basis. And that's because, again, rates have actually gone up, so returns in bond markets actually outstrip that of what you can get in cash. And then even if in the scenario where we've looked at also different past rate hike cycles, be it when the Fed cuts immediately, higher for longer, or a pause and then a cut, so different types of scenarios. In all scenarios, bonds actually outperform cash over, say, call it a 2 to 3 years time horizon. So we think that for the patient investor right now, bonds actually make a lot of sense from a return standpoint. So, and the third point is that bonds also provide a very good downside hedge against recession as compared to cash. At PIMCO, our base case is calling for recession in the next 6 to 12 months in our cyclical horizon. And that's because our expectation is that fiscal policy will start to recede, and the tighter monetary policy will start to drag growth downwards. So we do think that in our base case, there's going to be a mild recession coming in our cyclical horizon, and that's where bonds will provide a very good positioning and hedge against your riskier assets in your portfolios. So we do think that all in all, bonds actually play a very important role right now and offer very attractive value versus cash. To your second question about how we view corporate credit versus structured credit at this point in time, given our base case where we do see elevated recession risk, we are a bit more cautious on corporate credit. In particular, some of the riskier segments of the corporate credit market, so for example, high yield, particularly lower rated, as well as some of the legacy private credit as well, where we see that these shorter duration of floating rate assets, given the high interest rate environment now, we are starting to see a bit of signs of strains, given the higher funding cost. Where we are favoring would be higher quality investment grade credits within corporates. And in particular, our high conviction is in the structured credit space, high quality assets with very resilient cash flows backed by your hard assets. If you look at valuations as well, we also find that structured credit looks a lot more attractive as compared to corporate credit. So take, for example, right now, across many different parts of the structured credit markets, valuations versus the 10-year average are at their top quintile, versus IG bonds right now, IG corporates, where they are around about fair value. So overall, our preference is still very much for structured credit.
Thank you. So both Alice and Wenting agree that we should stay invested other than cash. Now, moving on to Hui Xian. In terms of duration, I think that's a question that comes up a lot. Obviously, the longer duration treasury products have really drawn down a lot over the last few years. What is your view and what is your recommendation on how you structure your bond portfolio at this moment?
That's a great question, and I love the build-up to the case for bonds, which is like half of what I do internally when getting shelf space or making the case versus equities, fixed income, and the rest. Agree with the framing. I mean, to Wenting's point, it really depends on what you need your bonds to do for you. If you need them for income vis-a-vis equity and REITs, in a very dividend-hungry type of market, that makes sense. That may not make so much sense to Alice's point when you compete on a relative value sense purely with the likes of T-bills right now. T-bills perform better than high yield this year. High yield's at second place, right? So this is the kind of new market we are living in, which is crazy exciting, at least compared to where we had no yields over the past 8 years. Now we have a lot of yield to play with, just where, and to your point, timing. So when constructing a diversified fixed income portfolio, today, you break it down duration and credit, if we go that way. Really easy stat, and I think both the panelists before I've tried to address this. The short duration is a gift. It's like water after being in a desert for a long time. It's such a no-brainer, but it's going to be temporary. Great mathematical stat we just worked out on the desk today as well. Perhaps in the belly, which is 5-year type of duration, it's a little bit of a sweet spot, because if rates rise another %, you won't be in a red, you won't lose money. If rates tighten another 100 basis points, you're 9%, happy days. So that's kind of the sweet spot and what we call portfolio ballast that has been restored a little bit on the duration side. Having said that, we also, make no mistake, we're entering a new regime where we are going to be higher for longer. We are holding tight at that level because of the threats to like recession and activity stagnating if and importantly inflation, right? If we don't stop holding tight at that high level. But then at that high level, which is 5%, 10 years last night, can it go to 6? Can it go to 7? There are reasons why, although we think less likely than it going to 4 or 3. We know one thing for sure, that is more macro uncertainty. More macro uncertainty whilst we chart the waters, but at the same time, you kind of have to be aware of the mega forces that are pretty structural. Like this is going to be a thing, right? AI is going to move portfolios, and AI is also, has implications on where duration goes. So holding those long, short term, I think what I wanted to bring to the table today was a little bit more on a point, maybe additive around nimbleness. So we would like to advocate perhaps for more granularity and agility in terms of portfolios. Yes, you should have your structural long-term asset allocation, diversification in the sense of equity fixed income makes perfect sense, but also diversification in the sense of toolkits, right? What is going to be your levers that you're going to be able to sell and buy more quickly, preserve your liquidity, don't bleed for 3-4% just because of T-cost. These are hard-earned day-to-day compounded returns. And that comes down to a lot of the things we've been doing in BlackRock, which is ensuring your portfolio has the right, this is stuff I'm going to hold, these are the bonds, these are the single lines, or this is the long-term equity bet that I cannot afford to lose, versus building a liquidity sleeve with whatever it is, with funds, with ETFs, with overlays for those of you who can, just to keep a fairly nimble tactical asset allocation. That's going to be a real key driving returns, we think, across the board. If we aggregate kind of all the investors' view in BlackRock. And then I would just add one point, duration we addressed. Credit risk, I think, would agree in terms of the relative value between investment grade and high yield. Investment grade super tight, Asia also super tight, and we're going to touch on that. But in a high yield space, number 2 in the rankings this year. You can't disagree with that. But the whole idea, bringing it together, is, you want that income because cash doesn't beat inflation anyway. High yield is the one who's going to give you a chance of beating inflation. Hold some of that, generate some income out of that, better value vis-a-vis equity. Hold that in an ETF, so when you need to sell it down or crank it up, it's quick and it doesn't cost you in and out, if that makes sense.
Thank you, Hui Xian. Moving on to Hilda. I know you're an Asian credit specialist, so I think a while ago when the interest regimes are close to 0%, people really looked at Asian credit for a source of yield. Now, developed market yields are high. So, where does Asian credit fit into that scheme, particularly with all the volatility we're seeing in the China property bonds and so on and so forth?
Yeah, thanks, Yu. I think that's a really valid question and something that I've been made to think about a lot in the past 2 years or so. So I think it's true that the negative news flow within China has really weighed down returns within Asian credit and of course weakened investor sentiment towards the space. But I think what many investors do not realize is that outside of some of these very well demarcated weak spots within Asian credit, China property for example, the other parts of Asian credit has actually been incredibly resilient. So for example, Asian investment grade has actually outperformed US IG and also EM IG on a year-to-date basis. And I think looking ahead, given how high yields have repriced, as the earlier panelist has already mentioned, we are actually pretty optimistic on the total returns in Asian credit going forward. So Asian credit is currently yielding about its 14-year high as we speak. So I'll give a few reasons why. So first and foremost, from a valuation standpoint, we think Asian credit still looks attractive relative to its DM equivalents. For example, in Asian IG, it's currently yielding about 20 basis points more than US IG. It might not seem like a lot, but this also comes at about 2 years less of duration in Asia as opposed to US. So overall, I would say from a yield versus duration standpoint, Asian credit still offers value to investors as opposed to its global counterparts. And as they mentioned earlier as well, given how high yields are, the income carry component is very high and therefore also offers very strong downside protection for potential volatility ahead. And the second point, which is perhaps even more important, is that we have to remember that Asia is not just about China. And within Asian credit, we still do see many interesting alpha opportunities for the taking, and at the same time, also many places where investors can hide from the volatile world that they're facing right now. India being a very good example, to us it still remains very much as a bright spot, supported by strong services growth and also domestic demand. Of course, this also leads to positive momentum for their corporate fundamentals. And even within China, we do see nascent signs of the economy bottoming out. And although we would still advocate for a lot of caution and also selectivity within that space, I would say that the overall consumption story remains intact. And from there are also good opportunities for investors to harvest. So all in all, I would say Asia is not a uniform bloc. It is actually made up of a very diverse set of economies that's driven by very different factors. And with that, it also gives the region very low correlation as opposed to the DM counterparts. So with that, it would also mean that apart from having attractive valuations, investors also stand to benefit or harvest the diversification potential by adding Asian credit into their existing portfolios.
Thank you very much. I think I was just looking at the Slido questions that have come in while we were speaking, and actually most of the questions are actually overlapping with, one of the questions was, some investor is actually invested in bonds 6 months ago and is underwater, and what should he do? Should he stay invested or should we get out? Does anyone want to take that question?
I think I go back to my earlier point. Actually, if we be a bit more granular with our bond allocation and just don't take bond as a, hey, I bought this 5-year or I bought this 10-year. Granted, it probably comes at a huge lot size, but with things like Endowus today, right, the Menka, the entry barrier to bonds are a lot lower now. So we have some luxury and privilege of segmenting. So think about bonds as what can I hold to maturity? What bits do I want to lock in, quote unquote, today, given there is potential to lock in 5-6%, versus what is more tactical than I need to play with, right? Funds, ETFs, all of that can achieve that outcome today that they cannot perhaps before. So if people are still, perhaps a bit more singularly treating that bond allocation as one single block, I think gone are those days. We hugely advocate fixed maturity pot, tactical liquid pot as your fixed income allocation.
Thank you. I'm afraid we've run out of time, but I think that the key message here is that despite the volatility and uncertainty that we're seeing, we should stay invested. We should look at particularly bonds from a total return perspective, not just yield. And when we construct balanced portfolios, it's balanced and diversified for a reason. And we need to take long-term views. And our stance at Endowus is really to take balanced and diversified views so you don't have to trade in and out and time the markets. I wish we had more time to discuss, but thanks all of the panelists today for participating in this panel. Thank you very much.
Thank you very much, Hugh. Thank you very much to our panelists. 35 minutes just went in such a flash. I got to say, I have a few of my own takeaways as well. And I love that this panel was all women, right? Yes. Super valuable takeaways. For me, it was patience, as always. And of course, taking a new look at old ideas. And I love the line that water after a desert is actually just temporary. It's just a temporary thirst quencher. And of course, having a nimble portfolio. But the last one, which I thought was extremely relevant, was Asia is a continent. A big thank you once again, a round of applause to our panelists and to Hugh. Please. As we move our entire room into our next convo, which is a pretty hot topic in Singapore right now, the future of family offices, fortune or flop. I'd now like to once again invite back to the stage Greg, and he's going to be moderating this panel alongside our esteemed speakers, Lynn Hermijanto, Principal TH3 Capital, Rajiv Natarajan, Managing Director, Head of Asia Pacific Iconic, Kenny Ho, Managing Partner, Carrot Private Wealth, Jimmy Lam, CIO, Pacific Eagle Asset Management. Welcome to all of our panelists, and I leave it in your good hands, Greg.
Thank you. Thank you so much. We had a pretty controversial title to this panel about family offices, fortune or flop. And I think in the last few years, we've seen an incredible amount of chatter around family offices, especially in the hubs, the wealth hubs of Singapore and Hong Kong. I read a stat a couple days ago that in 2018, there were 50 family offices in Singapore. And today, they estimate over 1,500. Okay, that is probably the fastest growing sector in Singapore. We assembled this panel today to be quite diverse, made of family principals, people running multi-family offices, people running or investing money on behalf of a principal as well. So really quickly, I want to introduce everybody. Lynn, next to me, she's a principal and founder of TH3 Capital, a single-family office based in Singapore. TH3 is deeply rooted in creating positive impact and has a culture of purposeful work and partnership to extend the family's legacy of giving back. Lynn is also currently a managing director at Deutsche Bank, where she has served many of Asia's wealthiest families for decades. Next to Lynn is Raj. Raj is MD and head of Asia Pacific for Iconic Capital, a privately held investment firm with over 80 billion in assets on behalf of some of the world's most influential families, pensions, sovereigns, and organizations. Prior to Iconic, Raj spent a decade at Goldman Sachs in various global offices. Kenny, to his left, managing director and founding partner of Keat Private, an Endowus Group company, which we acquired a majority stake of last year. Keat is a multifamily office, or what they call EAM, based in Hong Kong, serving mainly Greater China tech executives and multi-generational Asian billionaire families. He brings over 25 years of experience, everything from McKinsey to Salomon Brothers, Credit Suisse, and most recently was on the original founding team of Julius Baer in Asia. And finally, Jimmy. Jimmy has been a portfolio manager for over 35 years, including 16 years at GIC, where he rose to become the head of global equity research. He is currently CIO for the liquid financial assets of Pacific Eagle Asset Management, which is one of the most established and largest single-family offices in Asia, with billions under management as a single family. So thank you so much for being here, everyone. I'm going to kick this off, actually, to Raj. Raj, the family office term has been used in many different ways the last few years. How would you define family office?
Well, thanks for clearly it's a loaded question. And the reason for that is it's clearly definitionally ambiguous. And the term family office means very different things to different people. And the reason for that is there's such a breadth of spectrum in terms of what a family office is and what it isn't. At one end of the spectrum, on say the right-hand side, you have incredibly large, very sophisticated, very well-resourced, infrastructure-strong, single-family offices that operate at a world-class and institutional-grade level. And they have two elements to their family office. They probably have an investment office, and then they have a services engine for lifestyle and other things. At the other end of the spectrum, you have, say, a family office with, say, $50, $100, $150 million of assets, still definitionally a family office, but they garner that definition often through virtue of the exemptions and some of the taxation schemes that you see in various jurisdictions, and that could be a principal plus administrative person plus a bookkeeper and maybe a pet, right? And so there, in that end of the spectrum, you see the definition of a family office also used. I think the harder definition is less the right-hand side or the left-hand side. I think the harder definition is in the middle, which is what does a $500 million to a $2 billion family office look like? And typically there are two parts to it. As I mentioned, the investment arm, and then there's a services arm. The investment arm is always really hard because at that level of scale, it's hard to figure out what to insource, what to outsource, what sort of pedigree of resources you can actually attract, retain, develop, groom, compensate, and where do you genuinely have sources of competitive advantage that you can scale, and especially sitting here in Singapore or other parts of the region. And so definitionally, I think it's very complicated, but the main thing I would say is that people often conflate the distinction between investment excellence and services excellence. Some family offices are investment first, services second. Other family offices are services first, investment second. But I think the best ones manage the calibration between the two in the most resource efficient way the best.
Okay, thanks, Raj. I mean, Jimmy, just from your experience and borrowing what Raj has said, family office is not just about asset management. What is the investment office in the family office you're running? Like, how do you define the purpose of the work that you're doing?
Family office is a very difficult concept. When I first joined the company 10 years ago and told my friends in the industry, friends from GIC, and I told them that I'm now with a family office, they all felt very sorry for me They thought that I'm going to have an office at home and no proper career. Okay, today I'm going to tell you what a family office is because it's something that many people are interested. I think the best way for me to explain to you is to tell you exactly what this family office does. This is a family office of one of the most successful business person I have known, Mr. Tanoto and his family, first generation wealth. And they have built over 55 years global business interests in leadership positions in pulp, paper, viscose fiber, palm oil, and significant interest in energy assets. And they are globally exposed and operate in 4 areas, ICBC, not the Chinese bank, don't get worried. I stand for Indonesia, C stand for China, B stand for Brazil, and C stand for Canada. Okay, there are 4 things that we do in the family office. Number 1, it is the family business. The family will come together to decide how to allocate capital, how to invest, which country to go into, and which product lines, upstream, downstream. That is very important. There's always the start of a family office. That is the family business. Then the second, which is also equally important and run by professionals, will be wealth transfer, right? The wealth the wealth planning part of it, which basically involve governance, constitution, the transfer of multi-generation wealth. The third part is what many of you in the audience will be familiar with, and that is the investment arm, and that is where I'm closely involved in. And the fourth part that we do is the Tanoto Foundation, which is the philanthropy arm of the Tanoto family. And here they have the founders, chairman, Mr. Tanoto, and his wife, Mrs. Tina Tanoto. They have this vision that they want to provide opportunities for people to realize their full potential. So in the countries that we operate in, Singapore, Brazil, China, and Indonesia, they do have a strong education program, scholarship program, leadership program, and medical research. And that is essentially the heart of the family office. So I guess for many here, you don't need to be doing all 4 functions. Some will be doing more, some will be doing less. But essentially, this is the heart of a family office.
Thanks, Jimmy. That's a great segue to Lynn. So you're the principal of a family, of your family. And how do you define success?
Actually, I loved the point that Raj made that there are no 2 family offices that are alike, because family offices are essentially private offices of families, and they would naturally mirror the values, the goals of the families. And success for us would mean that the family office fulfills its goals and missions of its principles. What's really important for my family has always been that we would be very good stewards to everything that's been placed on our hands. So when we conceived the private office, it really was meant to grow and protect our financial interests so that we could do 2 things. The first being directing capital for good, so that we could make a positive impact in the communities and in the ecosystems that we're operating in. And the second thing would be to secure a good future for ourselves and for the generations after. So success in a family office to me would look like the office really helping us navigate the complexities of asset management, of philanthropy, as well as helping us navigate the challenges of leadership transition and wealth transition.
Okay, thanks, Lynn. Kenny, you talk to many families on a daily basis. Is the way they define success similar? Is the service you're offering the same, or how do you think about it? Right? Are there strategic goals that these families are after?
Actually, it's interesting. I'm also learning as I hear my esteemed panelists speak, and I'm trying to, I think, cut up the same pie in different ways, so let me try to do that. First of all, we look at wealth, and because we manage quite a number of clients. We have our single-family offices that we manage, and as Greg said, we have our EAM business, which tends to be smaller. So the way I look at wealth, I mean, and this is very broadly speaking, on the one level is kind of like the size, because it does change the way people think. So typically, in like the below 5 million, that's where we work very closely with Endowus, especially with the next gen, and that's an area which we're very excited about in terms of working with Endowus. We have a number of our clients, and it's the biggest part of our growing book, which is kind of the $5 to $200 million range, which is a lot of these, what we call them, that's where we handle our multifamily office business, and that's growing quite a bit. And of course, I'm just picking a number here, 200 plus million is where people really start developing and setting up their family offices. And that's a big part of our core business and how we started up Keat Private in Hong Kong and Singapore. Another way we look at the business is kind of what generational wealth that people are. So as Greg said, about 60% of our business is coming from Greater China. The rest of that business is coming from around Southeast Asia. And depending on the generational wealth, the goals are very different, okay? So I would say, and again, I'm cutting up the pie slightly differently, but it's the same thing. The first thing when people bring us aboard is kind of wealth representation. And this is one of the key reasons why we teamed up, and we are very happy to team up with Endowus, which is we have this fundamental belief that those representing the bank are representing the bank and not the client. So we spend a lot of time finding the best custodians. We have to filter through tons of different products. We have to find great product providers for access for our clients. So this is the purest form of what I call open architecture and open custodian. So wealth representation, wealth optimization, where we're, again, looking at investments across, I mean, to be honest, most of our clients are not looking to maximize their investing. They're looking to optimize it. And by that, I mean wealth preservation, okay? Last year, this covers the first two issues, but last year was a big year for us because we really, I mean, I had to make so many phone calls on the bank formerly known as Credit Suisse, so it kept me very, very busy last year. And then the third main area which we're looking at, again, is wealth structuring. That's everything from setting up private label funds, VCCs, various intermediary structures, looking at trusts, foundations, optimizing tax structures, going to setting up probate structures for Cayman, BVI, what have you, hiring educational consultants for people looking at Deerfield Academy in the United States, so on and so forth. We're doing a lot of that. And again, for us, it's really outsourcing this stuff, but it's just that we've come across so many of these different issues. Now, again, as Raj said, there's the black side, the white side, and there's a gray side. So different goals, but I would say that those goals are definitely guided by what generational wealth. And again, for our client base, just say a lot of the tech guys coming out of Greater China, who are, by the way, setting up family offices here in Singapore, clearly the way it's actually less on the investment side. And that's why Singapore is so, those numbers are absolutely true. I mean, I also know the numbers in Hong Kong. It's nowhere near the 1,500 that we're seeing here in Singapore. So Singapore has done a fantastic job, and I think all of us have to adjust the services that we provide and how we approach our clients.
Okay, so that's a great segue into, so Raj, a question for you, and Kenny, and anyone can chime in here. Let's think about the math behind setting up and operating a single family office and when it may or may not make sense.
Okay, so the overarching comment I'd make on this question is it's probably the greatest single miscalculation that we see occur amongst family offices that establish. About 12 years ago when we established our business, we took the liberty of traveling the world, and we met with some of the most successful single-family offices on the planet, everywhere from the East Coast of the United States all the way to Europe, out here in Asia. And one of the things that we learned is that there are certain operating expenses that you need to consume as a single-family office that, depending on the mission and purpose of what you're really focused on, in order to qualify you as genuinely world-class. And the reason why I think it's important to aspire to being world-class is the capital that's been generated to seed the family office has obviously been incredibly hard-earned. And as a steward of that capital for multiple generations, then you want the best eyes, ears, and infrastructure to support the allocation of that capital and the services that you provide around that family office. And so as a result of the work that we did, and we track this every year, I would say last year we find that a family office of a single family office with a quantum of, say, $1 billion is probably having a $5 to $7 million a year per annum operating expense for both primarily their investment team and some services. And so the question you got to ask yourself is that if you are below that number, and say meaningfully below that number, can you afford to spend $5 to $7 million of operating expense in order to justify that world-class investment capability? Some single-family offices of size, scale, sophistication can, but many cannot. And so I think there is a very significant miscalculation in order to arrive at what an appropriate team looks like. And so we found that anything below sort of $1 billion, it makes sense to figure out what you insource, what you outsource, what's the right hybrid approach, and how can you scale into world-class investment capability on a global basis. It's very hard to do that intermediating investment markets sitting here in Southeast Asia.
Awesome. Okay, so, I mean, it's a misnomer because, if I had $100 million of liquid capital, and that doesn't include my operating business, I could have a huge operating business as well. If I had $100 million of liquid capital, I would be an extremely, extremely, extremely wealthy person. But having a family office, perhaps, with all that infrastructure, so trying to insource a lot of those things could end up being very costly because you quote $5 million in operating expense. That's a 5%, what we call in the business, total expense ratio already before I even deploy a dollar. So, coming back, I think it comes back to how we define a family office, which is really important. And I think a lot of people who are setting up family offices think they need all that infrastructure.
Correct.
But that is probably a miscalculation. So, Lynn, how do you think about what you insource, outsource, work with service providers to really get best-in-class outcomes?
Right. Actually, I like to attack the question on costs. We don't spend $5 million a year on costs, but cost is a subject that is raised very often. It's going up every year, like the cost of Japanese food in Singapore. So, but for us, we think about the costs associated with not having a family office. We really like the tax clarity and tax efficiency that we get operating out of Singapore. And we've seen really the benefits of being able to pull resources from various family members and develop scale that we could have direct access to some of the best GPs across asset classes. We're talking about the likes of Apollo for private credit or Brookfield for infrastructure, and that's made us very happy because we're able to access them directly and we're able to access them at a cheaper price without having to go through the banks. And let's not forget the benefits of just having centralized control over your business investments as well as risk management. And for us, what is the most important thing is having a structure that provides continuity through generations, which is needed for legacy creation. So every time the subject of cost comes up, we think about what will it cost us to not have a structure like this? Because all these points that are important to us, we would not be able to achieve without having a family office or private investment office in place. And so that's how we think about it. But we don't do things as extensively as I would say with Raj's shop or even Jimmy's shop. We don't have our own PMs. We spend most of our time selecting managers, or the investment team does that, not me. And the game plan is to not do your own equity or credit selection, but to work with the best managers out there to help us streamline our costs. So that's one thing we do. We don't have our own research people. We basically subscribe to research pieces and work with entities like Cambridge. So that's what we do.
Okay, great. Thanks, Lynn. I like that. I like that the cost of not having is a great way to think about it. Key takeaway there is that people who are considering the setup should definitely make that calculation before they set up. And it's also very important to understand, I think, how difficult it is to recover a lot of that cost in investment outcomes by nature of how markets actually function. Thinking ahead, and this is my last question, everyone can answer, but I want to start with Jimmy. When you think about generational wealth pass-through, so passing down through generations, and we're obviously reaching a point in Asia where a lot of wealth is passing from G1 to G2 or even G2 to G3s. How do you think about keeping all the wealth together as one, splitting the wealth into different pies so you empower in a different way? Like what kind of structures do you find to be successful?
Okay, right now, we have one family office, and it serves the family very well. We are talking about first generation wealth and second generation wealth. And the reason is this, that you have a founder who has made all this money, and he has a vision, and he wants to pass on to the children and their children. And in this regard, he is driving the whole show. He has set the vision and set the values. And when it comes to investment, also has set the process so that everybody understands the investment process. You have to understand, like the answers just now, that this business is an economies of scale business. The bigger you are, the more benefits you have. What are some of the benefits? The benefits are, number one, you can hire the best people. Number two, you can operate in a lot more areas. Number three, you have access to a lot more products. People want to talk to you. People want to show you their product. The top PE firms in the world will want to do business with you. And number four, you will have all the co-investment opportunities with some of the top firms in the world. And some of those opportunities can turn out to be complementary to our existing businesses. So the point I'm trying to make here is that it's a significant economies of scale advantage in this business. And therefore, the bigger you are, the better it will be. So it is unwise to have one family office broken up into many, many family offices over time. So it is very clear that we have been in this from 2002, 20 years already. We have continued the process, long journey, and stayed as one family office, and it is likely to be the case for many generations to come for them because of economies of scale. Of course, there will be a situation where in one generation, somebody hit a jackpot like Facebook or something, and then that guy wants to set up his own family office and can see that family office will exist as part of the original family office. But for now, it is one family office because there's a lot of economies of scale advantages.
This is a very difficult question to answer. I feel like, because every year we probably do around 20 to 25 what I call interns, and these are people anywhere from 18 years old to 30 years old, where we have them run through this internship, and we train them up. We walk them, we have them sit down and go through all the family governance type issues of their particular family. We have them sit down with various government officials to talk about, family office setup and setting up VCCs and what have you. I'll tell you why it's difficult, because we got people who, they might have gone to NUS or Cambridge or whatever, but they're sitting in Lang Kwai Fung the whole time, that's where their head is. And then there's others who take this very, very seriously, where they're actually paying attention at the particular investment issues or the transitional issues. So, but we're doing our best in terms of trying to set up the best structures. And one area, in fact, just throw it in there, one area which we like working with Endowus is really getting that next generation really involved and having the platform of Endowus for that next generation, we believe has been very helpful for us.
Thanks for the ad, Kenny. But, Raj, of course, Iconics worked with families all over the world. Like, what have you observed in a few bullet points?
I would concur everything that everyone said. The only thing I would add to what's been said is I think sometimes people make the mistake in the establishment of family office between the concept of risk-taking, risk allocation, and risk transfer. And I think Lynn was saying partnering with managers who've got competitive advantage. And I think sometimes family offices make the mistake that they think they're in the risk-taking business. They are not in the risk-taking business. They are in the risk transfer business. Their job is to partner with people that have genuine competitive advantage and access and expertise in areas that help them furnish their allocations, aligning them to their risk-adjusted objectives for the long term. And I think that's the one big lesson from family office evolutions from 1.0 to 5.0.
Wonderful. Thank you, everyone. That's all we have time for.
Thank you.
Thank you for joining us today. Thank you for listening, everyone. Thank you.
Thank you very much, Greg, and to our panelists for the robust discussion.
Thank you. Thank you. Thank you. Thank you.
Thank you.
Oh.
That robust discussion on the visions, the pitfalls, the costs, the strategies and the future trends of family offices, and that Lan Kwai Fong is not it. Ladies and gentlemen, I would like to invite all of you for a quick tea break outside, and in 20 minutes from now, we'll have a fireside chat featuring our esteemed guest of honor, Singapore Deputy Prime Minister and Coordinating Minister for Economic Policies, Mr. Heng Swee Keat. Please enjoy the refreshments out in the foyer, and please be back in the room in 20 minutes. Thank you.
Why you gotta ask me hard questions like this, sir?
I'm very much focused on running the business.
We wake up thinking about business, we go to sleep thinking about business.
You don't know when the next paycheck is going to come by or how big that paycheck is going to be.
End of the day, it's hard-earned money, so you need to know where you're putting your funds in, not just go with the flow.
When it comes to investing, I do find it a little bit tricky because I don't have any finance training or any finance background.
I am a first-time investor, and I like knowing that I'm in fairly safe hands. I have an advisor here who actually has my best interests at heart, and that's how it feels.
Being on a platform like Endowus, I can kind of set it and forget it and leave it in the hands of the experts.
It's one of the platforms that really gives me full control.
Very seamless, very easy to use.
Not even having to worry about what my money is doing and freeing up my time and my mind space to be able to do the things that I really want to do.
Total of 48 cents in my CPF. Not my proudest day, no. I grew up feeling quite financially insecure. I was saving as much as possible, trying to get any job I could possibly find, just to give myself that sense of security. I had a problem spending money, even when I was earning more money. Downsides to being a freelancer, of course, would be security and stability. You don't know when the next paycheck is going to come by or how big that paycheck is going to be. The Endowus app is very easy to access. It very quickly shows me the breakdown of the portfolios and exactly where my money is going. When I was trying to map out exactly what my financial goals were, I sat down with my financial advisor from Endowus, and she was the one that kind of walked me through this process. It's a very calculated way of determining how I can reach the different goals that I had in mind. It made me feel more confident about putting my money down and investing with Endowus. Now, I am thinking of a much bigger picture. What am I saving for? And what goals am I working towards? When I think about what my future may look like, the kind of adventures that I want to go on, people that I'm going to meet, just the ability to dream beyond my present life.
That's a deep question. You start with that?
Why you gotta ask me hard questions like this, sir?
I'm very much focused on running the business.
We wake up thinking about business, we go to sleep thinking about business.
You don't know when the next paycheck is going to come by or how big that paycheck is gonna be.
End of the day, it's hard-earned money, so you need to know where you're putting your funds in, not just go with the flow.
When it comes to investing, I do find it a little bit tricky because I don't have any finance training or any finance background.
I am a first-time investor, and I like knowing that I'm in fairly safe hands. I have an advisor here who actually has my best interests at heart, and that's how it feels.
Being on a platform like Endowus, I can kind of set it and forget it and leave it in the hands of the experts.
It's one of the platforms that really gives me full control.
Very seamless, very easy to use.
Not even having to worry about what my money is doing and freeing up my time and my mind space to be able to do the things that I really want to do.
Of 48 cents in my CPF. Not my proudest day, no. I grew up feeling quite financially insecure. I was saving as much as possible, trying to get any job I could possibly find, just to give myself that sense of security. I had a problem spending money, even when I was earning more money. Downsides to being a freelancer, of course, would be security and stability. You don't know when the next paycheck is going to come by or how big that paycheck is going to be. The Endowus app is very easy to access. It very quickly shows me the breakdown of the portfolios and exactly where my money is going. When I was trying to map out exactly what my financial goals were, I sat down with my financial advisor from Endowus, and she was the one that kind of walked me through this process. It's a very calculated way of determining how I can reach the different goals that I had in mind. It made me feel more confident about putting my money down and investing with Endowus. Now, I am thinking of a much bigger picture. What am I saving for? And what goals am I working towards? When I think about what my future may look like, the kind of adventures that I want to go on, people that I'm going to meet, just the ability to dream beyond my present life.
That?
Why you gotta ask me hard questions like this, sir?
I'm very much focused on running the business.
We wake up thinking about business, we go to sleep thinking about business.
You don't know when the next paycheck is going to come by or how big that paycheck is gonna be.
End of the day, it's hard-earned money, so you need to know where you're putting your funds in, not just go with the flow.
When it comes to investing, I do find it a little bit tricky because I don't have any finance training or any finance background.
I am a first-time investor, and I like knowing that I'm in fairly safe hands. I have an advisor here who actually has my...
Ladies and gentlemen, if I could kindly ask you to quickly take your seats.
Freeing up my time and my mind space to be able to do the things that I really want to do.
Everybody, I hope you had a really lovely break and are very much ready for the rest of this power-packed afternoon. I have the privilege to introduce our distinguished guests for the upcoming fireside chat, Creating Equitable Opportunities for All, also my favorite topic of today. It is with great pleasure that we welcome on stage Singapore Deputy Prime Minister and Minister for Economic Policies, Mr. Heng Keat, and Sam Rhee, Chairman and Chief Investment Officer of Endowus.
Good to see you.
Good to see you.
It's wonderful to have you, DPM, here today. I think you have some prepared remarks for us. Would you like to start with that before we jump into the questions, or?
Well, I can say a few words at the start.
Yes, thank you.
First, happy to see so many of you here today, all very concerned about wealth management and asset management, and also on this to have this conference on WealthTech. Now, the way that we manage financial assets is critical not only to our personal well-being, but also to the health of the global economy. I happen to have gone through in my work the few major crises in our financial system. The Asian financial crisis, the global financial crisis when I was running the central bank, and the COVID pandemic when I was the Minister for Finance. And when you look back at all those episodes, you realize that one, financial crises are recurring parts of the global economy and of the financial system. We just have to learn to manage risk well. And two, that we need to be prepared to deal with crisis. And three, it's important for us to make sure that financial assets are deployed well for economic growth with a close linkage to the real economy. So if you look at the Asian crisis, I think some countries made mistakes in the way that they were managing the exchange rate system, in the assumptions that they made, especially among the large corporates on exchange rate risk and interest rate risk. And in the end, it can bring down and then the whole economy in a very significant way. If you look at the global financial crisis, I think unfortunately some of the well-known and very old financial institutions were brought down because some clever folks decided to do financial engineering and manufacture CDO products, turn what were junk assets into AAA assets, and it led to huge questions about how did that happen, how did that happen, and why is it that so many people were buying assets without realizing it? And I happen to know of a bank that, which I should not name, but they did an excellent job because they avoided a crisis and became really strong after that. And the only thing that they did very differently from the bank that failed, whom I also know very well, is that they were careful because they ran a retail operations as well as a big investment banking operation. They decided to investigate when the group CEO was told that, we have got these wonderful assets and it's growing so well. And he said, who are we lending this money to? To buy houses and all that. What is the credit checks that you have done? And after the investigation, realized that, my goodness, you guys were just doing clever financial engineering and this will not last. And he decided to pull out of everything. And so he pulled out in time to avoid a major, major crisis because it was a very, very big bank. So I would say that how we ensure that it is well, how finance is properly channeled to productive users to support the growth of the real economy is going to be a critical part of whether it can earn the right returns. Right? And two, if you look at the global, some of the best financial markets in the world, you have very rich offerings of capital. And those range of capital offerings, from VCs to private equity and VCs of different, at different stages to private equity, to funds that provide for M&A, to provide for corporate loans and so on, and the corporate bond market, allow for companies to access capital, allow for entrepreneurs to access capital. And when you have very good folks that are doing proper risk management, and you're getting the right risk-return profile, you get good economic growth, good returns. And so that is the way that I think we must regulate our financial system. We must run our financial system, even for bankers, for financial advisors, to ensure that you are backing something substantial. You are not backing a house of sand. You are not backing a Ponzi scheme. That it gives you real returns in the long run. Now, when it comes to individual, I would just say that the Singapore government has taken a rather, I would say, somewhat unconventional approach to the way that we help citizens manage our finances. First, when we think about wealth, we should not just be thinking in terms of financial assets, because I would take a broader view that wealth is anything that allows you to improve your well-being, to allow you to meet your basic necessities, and in the long run to improve your well-being. Now, in many aspects of the Singapore system, we don't run a big welfare system that says, well, you pay high taxes and you get free this, free that, and so on. Rather, we run a very disciplined system of ensuring that there are proper incentives for people to make the right decisions and not to waste resources. But at the same time, there's a huge amount of government spending and subsidies on the things that matter most to almost everybody, especially those from the lower income group. So let me name a few. First is housing. Practically, over 80% of our people live in HDB housing, highly subsidized. It is a big capital subsidy, essentially, because the house that we bought, is a big subsidy because you can look at the data from HDB and so on. And two, we are very fortunate to have that very early on at the start of almost at independence. Because if you look at all developing economies, one of the assets that grow the most when there's confidence in the economy, when there's confidence in the future earning, is that housing prices go up. And many of our HDB flats, the prices have gone up quite a lot if they're bought 30, 40, 50 years ago. Now, this is not a statement for you to speculate in property. I'm just stating a fact, right? And I said they bought it 30, 40, 50 years ago. So the past performance is not a prediction of future performance, right? You must have heard a lot.
That was going to be my disclaimer.
So, but if you look at, for example, I was very moved a few months back, or maybe a year back, when a lady in her late 50s came up to me when I was walking in the market in my constituency and said, Mr. Heng, I want to thank the government. I said, oh, why? He said, I've been living in this HDB, my husband and I have been living in this HDB flat for over 40 years. And now our kids have grown up. They both have their own HDB flat. Now, unfortunately, 6 months ago, my husband had a stroke. And so we decided that the 4-room flat is too big for us. We then applied for a 2-room flexi flat. I sold the flat and I had about $250,000, $300,000 of capital gain, more than enough to look after my husband and look after ourselves. And there was a big wealth gain that they had. So I say I'm so glad that we had a policy where, this people, our citizens owning their own flat is such a valuable part of our growth and of really distributing wealth very broadly. So that's one big item. The second big item is education. We take education very seriously. And education in Singapore in the primary, secondary school is free. And then when it goes to the institutes of higher learning, it's also highly subsidized. Even at university, students pay fees no more than 25% of the cost. And so it is an investment in human capital that allows individuals to really make the best of their ability, of their potential, to realize their potential. And with that, now you have Skills Future and all sorts of programs to encourage everyone to upgrade. Because I think by investing in human capital, it provides you with a long-term source of wealth. And the other, of course, is healthcare. So when you look at whether it is health and so on, it's all a big item. And the last is, of course, the compulsory CPF savings, which everybody, from time to time grumble, but then the smart ones actually make the best use of the CPF scheme. Because that compulsory saving has been very helpful. And interest rates on the CPF have actually increased. I think, when you look at CPF, I was just checking the latest number. The OA rate, the ordinary account, is now 2.5%. The special account and the MediSave account is 4.04%. And the retirement account is 4%. And then for those, the first 60,000, you actually get extra interest. If you're below 55, you get 1% more. If you're above 55, you get 2% more, which goes up to 6%. You can check the website. Now, it is risk-free, and there is no savings scheme that gives you a risk-free rate of that amount. And how do we make the best use? But of course, there is a limit, because this is only up to the first, for the first 60,000 that you get this extra. To help people build up enough of their retirement account. So I would say that on the government side, there's a huge amount of support for people to build their earnings, to build their wealth, to build this their health. But at the same time, I think there are many individuals, especially all those of you here in this room, who have more than that to have to think hard about investing seriously, investing for the long term. And I think what you are doing here, Sam, with your platform, I think will be very helpful. And I think you will know what your platform does better than me. We just had a long chat about what is it that you are doing. And I think it is a valuable thing for all of us to take charge of your own savings and investment, and also to plan what your needs are, what your spending needs are going to be in the coming years, how much you can set aside, how much you need, what are your goals, and how best to reach it in the best possible way with the right risk-return profile.
Thank you, DPM. I didn't ask him to give a plug to Endowus. Um, but DPM, thank you so much for your sharing. I do want to maybe start off with some questions, starting with the macro. The bank that was unnamed earlier shares half the name with my former company, Morgan Stanley, and the CEO is Nick. His first name is Jamie. But Jamie's been very bearish recently, and so I wanted to start with that because, you know, when COVID ended, we all thought, hey, life is going to come back to normal very quickly. But obviously that's not been the case. In hindsight, COVID has created massive disruptions to the global supply chain, in the behavior of companies and individuals. We've seen a huge change in the geopolitical tension. And I think some rogue actors have taken opportunity to show aggression, you know, whether it's Ukraine or Afghanistan or the current Israeli-Palestinian situation. So given that like significant economic and geopolitical development globally in recent years, maybe we can start with that macro, because as individuals here, I think the things that we want to focus most on and we're most concerned about is stability and also growth. And Singapore obviously is probably the most exemplary, you know, example of how we've achieved that in the past few decades. But going forward, what are your thoughts, you know, regarding the global growth prospect and maybe some of the geopolitical circumstance that we're in?
How long term or short term are you thinking of?
3 minutes.
You mean growth in the next 3 minutes?
Whatever you want to share, whatever you want to share, long term, short term. But I think for us, medium to longer term is more important. I think the short term is something that is more difficult to predict, whether it's financial markets or geopolitics. So maybe some thoughts about the medium, long term prospects of, you know, globally, but also where Singapore sits in that.
Right. So first, maybe let me start by looking at some of the numbers which IMF have put out. Right? So IMF projection for the global economy for 2023 and 2024, global is about 3%, 3% and 2.9% next year. And their projection for Asia is 4.6 and 4.2, with China growing at 5% and 4.2% this year and next year. So if you look at those, and India at 6.3 for both years. So if you look at those numbers, it's not, it is slower compared to before, especially for China. And therefore, China is such a big part of the global economy, the Asian numbers also gets pulled down. But nevertheless, it's still fairly good numbers. But of course, those are economy-wide numbers. There will be sectoral differences. And it's important for us to, you know, as investors, to look at, depending on what your investment profile is, because some of you might be investing in particular assets, some of you may particularly investing in particular parts of the world. So it really, that broad number, I suppose, give us some comfort that it is not going to a deep recession tomorrow. But on the other hand, I think the high global interest rates globally and the high inflation and the geopolitical uncertainty means that you got to be prepared that things can go wrong. I've seen so many reports predicting, for example, a US recession, a global recession, but it has not happened. And the question is, would there be a sharp correction? All that I can say is that, Sam, I don't know. Otherwise, I would have been a very rich man, right? If I can predict the future, that it is full of uncertainty. So I would say that you just have to, none of us have a good enough crystal ball to say growth will be exactly X or Y. Every investment
That's why
company,
you and I are both here. Yeah.
that all we can do is to say, well, you know, be prepared. I mean, be prepared for surprises. I mentioned earlier on about the importance of good risk management. And if you have enough cash, enough of your savings to say, well, my portfolio allocation allows me to take some high-risk assets, betting that there will be no problem, well, I would say go ahead. But if your risk profile is such that either you're not willing to take it or your circumstances don't allow you to take it, then I would say you will need to manage that risk more carefully.
Absolutely wonderful. Thank you. And you were the managing director of MAS during a very critical stage in Singapore's development through the global financial crisis, as you shared earlier. And you still serve to this day as a director of the board, on the board. And you've also led the finance ministry. So, multiple roles in important periods of Singapore's development. In your observation, I think Singapore's wealth management industry, Singapore is the Switzerland of Asia. It's where $2.5 trillion of wealth have accumulated. We are the center for the region, whether it's Southeast Asia, South Asia. What have you seen in the wealth management industry? How have you seen that evolve? And what are the key reasons for the success of, do you think, in Singapore? And what is the role of today's session is the WealthTech. What is the role of technology, do you think, in providing better wealth for individuals?
Well, I think it is a good thing that the Asian economies are growing well, and therefore you are generating a lot more wealth to be invested in. The question is, how do you invest? How do countries and companies invest well to ensure the long-term growth of this of the economy and therefore the well-being of the people? So I would say that one good trend is that following the Asian crisis, the global crisis, there are a lot more companies that are taking risk management much more seriously. In fact, I was speaking to one of the central bank governors when I was running the central bank, and I said, well, during the global financial crisis, companies in your country did not suffer as much as they did during the Asian crisis. What did you do? And he said, well, actually, all the players became a lot more careful. They all knew the importance of providing enough buffers. They actually, even the companies stress test their assets to make sure that if there was a turn in the growth number, if there was a sharp change in the exchange rate, what would their risk be and how they could manage that. So when you look back and look at the global financial crisis, I think one major, the COVID global financial crisis, I'm glad that while the crisis started in the US and then spread to Europe, the rest of Asia also were affected, but the real economy was not as damaged. Of course, global growth came down and then we all suffered. But what is interesting is that during the COVID crisis, it was government that played the important role of coming in to step up to deal with the crisis. And almost every government provided significant support to the people, to the economy, and that allowed companies to bounce back and workers to bounce back quickly. And since you gave me the opportunity, I must make a short plug for what Singapore did, right? That I was finance minister at that time. It was horribly stressful. Yeah, in 2020 I did 5 budgets, and we allocated in the end another $100 billion. Our budget is about 100 billion, about 20% of our GDP. And in one year, 2020 was a year we allocated almost $200 billion of budget, when a normal budget for a year is about 100 billion. But so over that 5 budget, we had to put out 100 billion. But out of the 100 billions, 60 over billion were from past reserves. That I had to see our elected presidents during this period ask for the use of the past reserves. Thankfully, the economy recovered a little better. But in the end, we used slightly over $40 billion of past reserves. Now, a billion is 1,000 million. And so, 40 billion is a huge...
Yeah. As far as I know, I think that's only happened twice in the history of Singapore, the global financial crisis and COVID. Is that right? And was COVID much bigger
Far bigger.
Far bigger than the
because global crisis. I think we asked for 4.9 billion, and we're able to return the 4.9 billion when the economy recovered. So I was asked, can you put back 40 over billion? I say, well, certainly not during my lifetime. I hope at some point, yeah. But the important thing is that the economy was well supported, and people's livelihood, were not hugely affected. I think we had all sorts of grant schemes for folks. Since this, I should tell you that at the end of the year, I was so tired. I ended up asking to take a few days off from my boss. I said, I need to recover. So my wife and I decided, because when the conditions allowed, we went to some of the restaurants. And when the restaurants were allowed to reopen. And practically in every restaurant I went to, they refused to bill me. So I say, no, I can't, because I don't want to be accused of any wrongdoing. Yeah. So I will pay for it. Yeah. But some of them were very sweet. They said, so usually at the end of the meal, my wife and I can't decide whether to have dessert A or dessert B. And so they saw us discussing, and they say, okay, Mr. Heng, I think this small little dessert won't corrupt you, right? So they gave us 2 desserts and charged me a price of 1. I said, well, thank you very much. Just a few dollars. I'm happy to accept that. But the sweetest thing was there was one restaurant where the manager went around and got every member of the staff to sign on the sheet of paper and say thank you. I mean, it was, after all the hard work, I thought, okay, I'm so glad. But I think I've gone to many restaurants who then later on told me that I think they are so glad that we saved the job and that we saved this, and the economy was able to bounce back. So I think it is important for us, whether as individuals, whether as a company, whether as a country, to have enough of our to make plans for contingency, so that we know that should things turn out very differently from our assumption, that you have a baseline, and have a baseline to bounce back, because otherwise you'll be quite troublesome. And in fact, I see many young people in this room. I assume that some of you are young Singaporeans, right? Yes?
Mostly.
I see.
Mostly.
Okay. So let me say what I've been telling young people, and let me repeat that message. I say you're very lucky that we supported the economy and we're able to bounce back, but you are not on the hook for paying for the bill. Because I'm probably the only finance minister who had done such a big support without borrowing a single cent. Without borrowing a single cent. Now, when you think about it, for a country with no oil, no gas, no mineral, who even have to import our water, it is quite remarkable. And I hope that it is something that we all treasure and not take things for granted, and that we all do our part to make sure that we keep up this system of, good governance, this system of thinking about not just ourselves, but the long-term future of our people and of our young generation.
Wonderful. Talking about long-term future, I think we've shared the mission of Endowus and how we wanted to tackle retirement adequacy as a core mission of the business, and why we, from the get-go, intentionally built a technology stack that serves the CPF investment scheme. And so maybe we can turn to that topic, which I know is also close to your heart. And in preparing Singapore for the future, CPF is an amazing scheme, a total social security system. But specific to retirement, we have CPF Life, which is not necessarily enough for all Singaporeans. And so I wonder if you can share some thoughts about what more we can do, both on the demand side, which is what we call financial demand side, which is actual individuals, how we need to do more for financial literacy education, help them to make better choices, be more aware, but also on the supply side, how financial institutions can be true fiduciaries and serve the best interests of the clients through better business models and platforms?
Well, I think that's a very good question. And so first, let me say that I mentioned about the CPF savings and how much, the interest rates that are being paid. And in a way, the CPF savings, if you think about it, it is really, when the way that it is managed, essentially is a very big pooled savings that is invested in globally diversified portfolio that provides a return that I would say that it's not even just risk adjusted, it's better than risk adjusted. But at the same time, there is a limit to how much that is done. And for all citizens, there is a basic retirement sum, there's basic sum for MediSave account and so on to ensure the financial adequacy. But for the older generations, you'll find that the healthcare cost, for example, is a very major issue, very major concern for many of our seniors. So we started with the Pioneer Generation package. I don't know, is there anyone in this room who is a recipient of the Pioneer Generation package? Nobody, all much younger. Anybody in the Merdeka generation? Also nobody, so all lots of young. Oh, one. Oh, okay. Yeah. So if a Merdeka generation, and then of course now, it's the Manjula generation. But in the case of the Pioneer generation and the Merdeka generation, they grew up at a time when Singapore's economy was not that well developed. We were just growing, we were just becoming independent. And many of the people in those days, wages were not high, and so savings were not adequate. So the effort to help build retirement savings for the older group, provide this healthcare, is a very important means of support. But at the same time, also the minimum sum. And you'll find that among the younger people, the basic retirement sum and the basic sum in the MediSave account have been a lot better. But I would say that beyond that, that's almost like a kind of a minimum, a baseline. But for those of you with with some extra resources, you should consider investing very carefully in a range of assets that meet your risk-return profile. And I would say that the younger you are, the better you are in a position to take on higher risk assets. So I would say that a wealth management industry that can provide for a good advice to clients to understand what is it that you are investing in. When I was in MAS, we started a program called Money Sense to basically instill or impart good asset management habits, good savings habit for Singapore students. In fact, I even considered whether we should do it as a compulsory module in school when I was education minister. But my teacher dissuaded me and said that, Minister, the kids are really very stressed with the homework. But they gave me a very good point. They said, I think it's really good to teach our kids mathematics and make sure they pass mathematics. I say, why? They say, for example, a simple knowledge of what is simple interest and what is compound interest and what is the effect of compounding is very valuable for managing their wealth and assets. I say, oh, great point. Right? So whether it is, so basic concept which allow, but I think we need to go beyond the basics of mathematics, but to now understand what are the risks and returns of different asset classes, how do you optimize your portfolio, and for most of us, you are not trying to be stock pickers, trying to look at which is the thing that you should bet on, but really the portfolio allocation that will determine your portfolio beta, basically. And with that mix, you can manage the risk return a lot better. So you'll be very good if we have platforms like that to enable us to better understand what are your risk appetite, what are your needs, what are your goals, and then at the same time, looking at the assets that you already have, whether it's in a house or in your CPF, to say, well, now that I've got this extra money, how do I make it work for me? And how do I make it work for me in a way that allows me to, maximize my, to be able to reach my goal?
Wonderful. At this point, I do want to open up the mic. We have 2 standing mics here. I don't know who came up with the idea, but university lecture style or PAP rally style, I don't know what it is, but whoever wants to stand up and maybe stand in front of the mic, I'll point to you. We do have some questions on Slido. So please, anybody who would like to ask a question to DPM, please come forward. In the meantime, I know that DPM, you're very open-minded and a great listener. And so of the questions, I think there are some, I guess it's a question formed into an opinion, I guess. It's an opinion formed into a question. So I'm going to give you some feedback, if that's okay, from the audience, not me. So don't blame me. There's one question, which is that with the US moving their qualification for AI, PIs, so Singapore has accredited investor scheme, which you helped introduce, a professional investor scheme in Hong Kong, from a wealth-based metric towards an education occupational metric. Could Singapore adopt this to increase access for investors to a wide range of financial products? So that's, I think, one feedback. The other one is, how Singapore can remain economically competitive, and while the economic benefits from a better financial system is a good thing, many might get left behind as well. And how can Singapore continue to create equitable opportunities for anyone? Maybe you can touch on that, because I think the topic today is creating equitable opportunities for all. We'll save that for you. And then I think do you think government revenues from individual taxation should be adjusted to also include more from the current non-paying taxpayers and not just rely on the upper middle class and above? I think that's also a feedback. So maybe we can, no questions from the floor. I'm a bit surprised. Not often that we get to ask a direct question to DPM. So don't feel shy if you want to. Sorry, over there? Where? Oh, over there. Yeah.
Now I was thinking, why not I answer your 3 questions first very briefly?
Yeah. Please,
okay.
Please.
Yeah. So your first question about whether MAS should change that. As a regulator for many years, I would say that the regulator should study this and then decide.
Great.
I'm not in a position to decide for the regulator at this point. Right?
Absolutely.
Now, on the second point about how do you keep the economy competitive, and the third question about access for everyone, I would say that on the taxes for everyone and how to keep the growth going, the last time I looked at the number, over 40%, I would say maybe even over 45% of our workers don't pay a single cent of income tax. Yeah, because our thresholds are so high. Yeah, and because we want to make sure that as far as possible, let individuals decide on their investment decisions and so on. And that is why we have a very careful system of social services that provides for all the critical needs, but not to overdo it and let people decide on what they want to do. But the second question about how do you keep the economy competitive, I think that is going to be a major theme, not just for Singapore, but for the whole world. The one thing which I didn't touch on when you asked me about Asia's growth and so on, is really that I think over the next 15, 20 years, you're going to see major structural changes in the global economy, largely because of the way that technology is moving, the way that the global market is moving. I think we had a very good period of globalization when China joined the global economy, when hundreds of millions of people joined the global workforce, when many countries in Asia started to adopt a very outward-oriented policy. We brought in investments and so on. And that period of globalization has brought in huge growth for everybody. Now, in the coming years, I think what you're likely to see is that with this US-China strategic competition, The one thing we need to watch is to what extent we will see a bifurcation of the economic system and of supply chain. I think there will be bifurcation in terms of the critical technologies. And when Secretary Janet Yellen mentioned about small yacht and high fence, I do hope that it is a small yacht, that the high fence only covers a small yacht. But there are many areas that we should be promoting more global cooperation, particularly when you look at issues like climate change. We should all be working together to invest in resources on climate change. We should all be investing in how we look at the energy transition. Now, I just came back from the US, visited a lot of research institutes and companies. I visited a facility of this company called, this startup rather, called Commonwealth Fusion Systems. And they are in the midst of working on fusion energy, which will be net zero, almost net zero. And there are so much of that work going on in the US, in the UK, in China, and in fact in France and many parts of Europe. So I think there is now a global race towards net zero, towards energy transition, which will reshape the global economy significantly. So that's one aspect. The green transition is going to be important, and that's certainly one area which Singapore must work on. The other major change that is coming our way is AI. Right? I think ChatGPT has taken a lot of people's interest, brought this whole topic of AI to everybody's attention. But I think the impact of AI and quantum computing is going to be very significant on the global economy. When the breakthrough will come, we don't know, but if you look at AI, it is really moving very quickly. And one of the things that Singapore must do is to make sure that we invest significantly. And the last thing I should say that is biotech. The genomics, the science of genomics of mRNA technology, which was what allowed us to have the COVID vaccine, is again going to change healthcare in many ways. And I visited some research institutes that are looking at the use of mRNA technology for dealing with cancer, one of the most deadly diseases on earth. So you will see huge changes that are coming our way, driven by technology, driven by competition, driven by the energy transition.
Well, there's two things I'm going to do, DPM, that your team doesn't know about, and so they're going to hate me for it. So the first one is I'm going to ask you, have you watched the Netflix documentary on Lee Kuan Yew in his voice? It's a CNA documentary. Obviously, you were the principal secretary for, at the time, Senior Minister Lee Kuan Yew. So just wonder if you've seen it and any thoughts? Bring back good memories?
I've actually seen many of his videos. And also, I'm very proud that I have 3 autographed copies, two of his memoirs and the third of the book called The Man and His Ideas, because I was his secretary when he was writing the memoirs and play a very tiny role.
Wonderful. And the other thing I'm going to do is take a selfie with you and the whole group. So thank you so much, DPM. Round of applause, and we're going to take a selfie with the whole crowd.
Ladies and gentlemen, a heartfelt thank you to Deputy Prime Minister Heng Keat for being here with us today and sharing your equitable perspectives on topics of importance to Singapore, the region, and the world. And of course, DPM has to take his immediate leave, but you don't have to. And I have a few little takeaways. Crisis always makes us smarter. I think don't build sand houses. I thought that was fantastic. Read up and understand the greater world movements. And my favorite of DPM's conversation today is that live a little, have dessert A and dessert B. Oop, we are ready. All right, and coming up, of course, McKinsey's latest report on WealthTech in Asia Pacific. I'm just going to let them pull everything together. Is everybody doing all right? Yes, lots of food for thought, lots of wealth information, but I felt that there was just a lot of sensible information as well underlying all of that. There's so many exciting changes and growths and developments in the world that we need to keep our finger on the pulse, but at the same time, things like, don't build a sand house, for example. Yeah. I feel like I'm going to be pushed off the stage any moment now. I'll probably have to move here because there's just so many people on stage in a second. And of course, please don't forget to share things that you've learned today, whether that's on Threads or X, or whether you are sending things out into Instagram. You do know that what our hashtag is today. You can tag us at Endowus as well. This is the toughest job in the world. It is, because there's so much pressure to make sure that none of those glasses fall. We're in one of the best hotels as well. Wonderful staff. Thank you guys so much. It gives me great pleasure to introduce our next guest. Joydeep Sengupta is the senior partner at McKinsey & Company, and he's going to present his key findings from McKinsey's latest report, WealthTech in Asia Pacific, the next frontier in financial innovation. Endowus is proud to be one of the key contributors to this incredible report, so please sit tight with it, which unpacks important insights on the evolving landscape of wealth management and the emergence of wealth tech as a force to be reckoned with. Please welcome Joydeep on stage, and after that, we're going to keep him on stage because he's going to be the moderator of the next panel. Joydeep, please.
Thank you. So good afternoon, everyone, and it's a real pleasure to be here and a real privilege to be talking to you about wealth tech. So why did we do a report on wealth tech? I mean, the main reason was, as we're thinking about all the technology shifts that's happening, the demographic changes that are happening around the region, one of the things we've always felt across Asia is that people have not really had access to financial services. And as we think about the role of wealth tech at a very fundamental level, it can achieve three major objectives. The first is accessibility, making products, advice accessible to a larger group of people at a cheaper cost, right? Which is the second point around affordability, right? Today, most wealth managers are really manufacturer-centric, right? Focusing on a lot of the income that they get. Who is customer-centric? And how can you make costs cheaper for customers? Affordability was the second major factor. And third is the big notion of advice for all, right? How do people get advice at a low cost and really pretty much for all their financial needs? So this notion of accessibility, affordability, and advice for all, we felt is quite an empowering thought which drives the wealth tech growth. Of course, it's enabled by all technologies that come in, etc. But I'll just use these three pillars as the primary reason and purpose why we chose to go down into this. Let me then take a little bit of time and talk a little bit about what's there in this report. And there are four things which we'll talk about today. The first is the dynamics of wealth management in the Asia-Pacific region. The second is what does it take to crack the code, right? There are many wealth tech firms, but they don't really scale. So what does it take to really scale? Third is what do future wealth techs look like and what could it be? And finally, ultimately, if you have to scale for profitable growth, what are some of the imperatives, some of the challenges that wealth techs face, and what are some of the imperatives? One of the things we were really grateful for over the last few months was the opportunity to talk to some of the leading wealth tech players in the region. Endowus certainly will be very grateful that they gave us an opportunity to interview them, but also others such as Addix, Quantifeed, and many others, Moonfair and many others. And we had real insights both in terms of all the things that they're doing, but also some of the challenges that they're facing, which we'll talk about today. First, before we talk about wealth tech, let's talk about wealth, right? So what's the opportunity? And it's staggering. If you look at the next 5 years, roughly Asia Pacific will account for about 81 trillion of total personal financial assets. Just to put it in perspective, that's roughly 50% of the global personal financial assets. So Asia is going to be half the world in terms of the size and scale of assets. Second, we expect the penetration of wealth management to start moving up from the existing 18 to 20% upwards to 27%. And that's quite significant, especially when we think about just what it would mean for the overall market for managed assets. And that's not all. We'll see that continuing over the next 2-3 decades, because if you look at developed markets like the US, it's already at about 45 to 50%. So the scope for penetration for wealth management is pretty massive. Number 3, as we think about some of the offshore centers, Singapore and Hong Kong, again, we're seeing significant flows. We expect that to go up to about 3.5 trillion over the next 5 years, roughly split between Hong Kong and Singapore, though some would argue that Singapore is likely to get a bigger share. And finally, I think pensions. You know, we talk about asset accumulation, but it's quite startling. If you look at pensions as a percentage of GDP in markets like the US, it's more than 175%. If you look at markets like Singapore, it's about 94%. But if you look at Indonesia and Malaysia, it's about 2%, right? So there is a massive pensions opportunity, both in ASEAN, but also across many of the other Asian markets, which will power the growth of wealth as well. So what's happening in the wealth tech industry? And I would say that, look, firstly, it's been exploding over the last 5 years. So we were trying to do a count, and we said that, look, as we speak, there are over 100 wealth techs in the region. If you look at the increase, it's been about 1.5x over the last 5 years, 8.8x growth in valuation, and about 10x increase in funding. Till more recently, I think, and I'll come back to the funding challenges, which I'm sure all wealth techs recognize in this environment. But really, I think the notion that we've had over 100 players, in that there are about 5 unicorns, mostly in India and China, and a couple more unicorns about to be unicorns, we are looking at a pretty thriving industry. And most of these players are broadly across 3 archetypes. First is direct to consumer, which is about a majority. And then increasingly, we are looking at models of wealth tech which are supporting other financial institutions as a B2B or B2BFI model, and or supporting financial advisors. So that's the opportunity. Exciting, highly valued, playing in an absolutely large revenue pool. So what are some of the challenges? And this is where, as we talked to many of the wealth tech firms, said that, look, it's great to get off the ground, but how do you really scale? And there are 5 or 6 major issues that most of the wealth techs face. The first is very much around the acquisition costs. I think conquering high acquisition costs remains a big challenge. Currently, acquisition costs range between $50 to $200 per customer, and the payback periods are quite high, right? If you think about continuing to acquire, the losses continue to accumulate over time. So that's challenge number 1. Is there a way to reduce that quite dramatically? Can you get this down? And in our definition, we would say, for a wealth tech player, eventually, can you get it down to $5? Or can you get it down to $1 even? Right? So that would be the first ambition and the first challenge to solve. Second is a funding gap. And I just said in my previous chart that, look, we've had 10x growth in funding, but in the last year, we've seen funding fall from about 150 billion down to about 80 billion, and the trend is going downwards. So if you think about scaling and the need for funding, how are wealth tech firms going to find that money? I think that's a second. Third, the notion of, and I think DPM talked a little bit about the efforts MAS had made in building financial literacy. I think that remains. Why is that relevant? Because wealth tech firms need to continue to spend money in branding, in customer education, in creating financial literacy, and that, of course, adds to the cost. So that's a third factor which we see a lot of wealth tech firms struggle with. Fourth is the democratization. You know, I said right in the beginning that accessibility is one of the core purpose of wealth techs, but it's not easy. How do you think about democratizing assets across? How do you think about fractionalization? How do you think about providing access to newer segments? How do you create liquidity in the market, in the private markets in particular? These are some of the challenges that we have seen. And then finally, I think going cross-border, there are multiple regulations in different markets. It's not so easy to do that. And indeed, I think if you think about scaling, you need to work in an ecosystem of a number of partners. But the ability to find the right partners, the ability to create seamless interactions, again becomes a challenge. So on the one hand, we are looking at an exciting industry. On the other hand, there are significant challenges that wealth tech firms face. So is there any wealth tech firm which has got this scale and been successful? And we looked around the world, and clearly there are some which are reaching there in terms of scale. And by scale, we are looking at just these 5 players, for example, each of them in excess of $40 to $50 billion of assets under management. If you look at their ratings, most of them are really well rated, and most of them are in the United States. Right? So there's one in Germany which is scalable. I'll go into each of this in a minute, but there are 4 or 5 characteristics which are common to most of them. Number one, they invest in personalized journeys. It's simple and meaningful, customer at the center. A lot of focus on data and analytics as a way to create personalization and a way to reduce costs. Emotional marketing, really playing to the needs of the customer and understanding both the sociological and the behavioral needs. And finally, I think making sure that they get the right kind of advice at a low cost, so improving productivity. And I think all of these players display these characteristics. Let me quickly just share a couple of them. Scalable. This was founded about 10 years ago. It's founded in Germany. And if you look at it, it started as a robo-advisory firm. But eventually, I think it's built up to a wealth management platform. What's characteristic is its unique intuitive journey, the fact that investments are highly personalized, and the pricing is simple and transparent. And I think when people play on this platform, I think they know what they get, and there are no hidden charges, and the costs are entirely to the customer. Wealthfront, this is an institution which was born in 2011. That's about almost 13 years ago. Primarily serves clients in the United States, but what's special about them is the range of product offerings. Go back to the notion of accessibility. If you look at the number of products they're able to offer, it's wide. Investments are automatic, and in many ways, you are able to rebalance your portfolios digitally, and the returns are very attractive in terms of what they've begun to offer. So again, if you think about this notion of how do you build something which is accessible, how do you build something which is scalable, I think Wealthfront is a terrific example of that. A different example is investment. And investment is much newer. It's barely 2 years old. And I think it operated in the US, 12 years old. It operated in the US, and it effectively operates as a platform. So it provides data analytics and insights to customers. It creates solutions, and it's open architecture. Open architecture in the sense that it's almost platform as a service model for different providers on this. And therefore, if you look at the scale of it, it's got about 107,000 advisors who operate on this platform, and there manages about $5.4 trillion of assets. So it's a slightly different, it's not a D2C model. It's a platform model, but again, a company which has got scale. So what does it all mean for wealth tech firms today? And I would say that there are 3 archetypes which are beginning to emerge. I think the first archetype is what we would call the D2C models, which started as pure digital plays, serving customers directly. But increasing over time, we are seeing them develop into much more of a hybrid distribution. So advisors for more affluent, for the upper mass and the affluent, are playing pretty much in the digital space. Second, I think we are seeing many of them extend to become technology providers. What does that mean? For many wealth managers, it's a terrific business model to support banks, which are actual wealth managers who have been traditional wealth managers, but really offer productized modules, technology solutions, and embed them into the banks. So becoming much more a B2B player rather than just a direct-to-consumer player. is the second trend that we are seeing. But we are also seeing many of the D2C players also offer a B2B offering. So it's a mix of both as well. And then finally, I think being an end-to-end solutions provider only, both for advisors as well as for the banks. So these are the three models which we are seeing emerging. But one of the things which we are seeing is this expansion across from sales all the way to execution. This is something we are seeing most WealthTechs now beginning to cross this entire spectrum. So what does it mean if they are doing all of that in terms of the size and scale of the opportunity that they can capture? Our sense is this is a space which will explode dramatically. In the next 5 years, we expect roughly AUM to go up about 3.3 times, from 0.7 to 2.1. And a big push will happen in the D2C segment. We think that that segment will go up from about roughly 200 billion to close to 800 billion over the next 5 years. And the B2B segment will go up by about 3 times, roughly to 1.5 trillion. So roughly we are expecting significant growth and then commensurate revenues as well going through with that. Many ask, why do we expect this to happen? What are the drivers? Where is the inflection point? And I would say that there are 3 elements which is really driving this. One, as we look at around the world, there is a certain amount of penetration of your mutual fund assets by GDP, which is roughly about 18% in the US, 18% or so in the developed Asia when it took off. And we are looking at in emerging Asia, that number being much lower, and we're in some markets approaching that threshold. And when you approach that threshold, you start getting growth more than 18 to 20% per annum. And we think that a lot of that will happen in the affluent and the upper mass segments, which is where wealth tech firms will be primarily dominant. So that's the reason why we see this explosion in growth, because we do see that inflection point coming in the next 1 to 2 years. So what do wealth tech firms have to do? And I'll just hit upon 6 areas which we think are really important looking forward. I think the first is really around having a strategic approach to partnerships. It's very clear that on your own, a wealth tech firm will be unlikely to reduce its acquisition costs and acquire customers at scale. So it needs a lot of partners, and it needs a lot of ecosystem partners. Who these partners are, what's the technological linkage that it can establish with them, I think will be very critical. So that's going to be the number 1 unlock, if you may. I think the second unlock is going to be around reimagining the geographic coverage. So really thinking through certain wealth corridors, thinking through how can you get advisors and investors who are operating or insiders in those markets who can get onto your board to facilitate, if you may, operations in other markets in the particular specific wealth corridors that wealth techs choose to apply. That could be a second area worth exploring. A third is really looking at continuing to focus on the things that we saw many of the large-scale players in the US and Germany do, which is around personalized digital experiences, much better customer engagement, and opening up many of the white spaces leveraging technology. So these 6 elements we think are going to be quite important for wealth techs to focus on as they think about the next wave of expansion. So I will stop now with 4 questions, and I'm going to invite a panel shortly for a discussion around some of this. I think the first question is, will we see the adoption of wealth tech, and will we see the movement of customers? You know, what will it take for people to be more self-directed or even partially self-directed from the old model of having relationship managers and advisors who are much more operating in a physical format? I think that's it. That's the first question, and I think the real question is, you know, how fast will that happen? Second is, what will be the impact on existing financial institutions? So is this going to be an era of competition, or is it going to be co-option and cooperation? That's the second question, and how and what's the right outcome for the industry and for the customers? Third is funding. You know, what's the likely funding outlook given some of the challenges that we've seen this year and likely moving forward? How will that be addressed? And finally, from a regulatory perspective, you know, what can regulators do? And again, we heard DPM talk a little bit about it, but more broadly speaking, MAS started the sandbox. There are many other geographies which are creating a sandbox. Is there an opportunity for someone to work with the regulators and create bilateral, by-country sandboxes? I think those are the kind of questions I think which will determine the scale and pace of growth. Again, there is this and a lot more in the report that we have. So I would encourage you to download the report and read it at your leisure. But at this point, thank you for listening to me so patiently. I'm happy to take any questions, or I could move on directly to the panel if you'd like.
You'd like to do, Georgie?
Okay, I'm happy to take a couple of questions. But,
Sure.
And then we can move on to the panel.
Sure. Do we have any questions in the room? And please feel free to use the microphones in the center of the room. Yes, we do, please, if you wouldn't mind.
Thank you for that. I'm Harman, and I think you might be addressing this in your panel discussion, but I wouldn't want to throw it out there. When it comes to existing financial institutions, the big fives in the U.S., your Goldmans and stuff, and we know specifically Goldman has tried Marcus, and it's now kind of retreating its digital transformation, digital penetration of the consumer market. So, and it didn't have, unlike some of the other big fives, it didn't have the brick and mortar branches that was holding it back. It was starting like a wealth tech. And yet it wasn't able to get that foothold in. So why do you think that is, seeing that it had so many advantages to penetrate the wealth tech market?
So thank you for that question. And I do think that if you look at many of the existing banks, I certainly won't write them off. I think I would argue that Marcus's journey, the reason was not that they couldn't do it. There were other factors, I think, which came into play in terms of their own priorities around where they would invest and how much they were willing to invest to make it happen. We can look at other players who are continuing that journey, like JP Morgan, for example, in Europe, right, with their digital tech platform. So we would see many other incumbents go through. My own view is, I think in the end, we will have a world where I think there will be some combinations between existing banks and wealth tech firms, because wealth tech firms have the capabilities, they've got the nimbleness, they've got a lot of the products and propositions, they've got the journeys. The incumbent firms have the customers at the end of the day. So there is something to be said about how they can work together to make this happen. But that's just my view.
Thank you very much for that great starting question. And it's perfect for us to be able to pivot into the panel. So wonderful. I'm going to ask you to...
I will come back in a second.
Okay, Jodie's going to come back. I'm going to introduce the panel. I love a man who takes control, Thank you very much, Joydeep. Really, that was very juicy research, really wonderful key findings and lots of thought-provoking insights. And let me now introduce the panel that comprises of wealth tech stalwarts, where we'll be diving deeper into key trends for this report. I seem to be having some speech problems at the moment. Gentlemen, please, on stage, please. Please join me in welcoming our speakers to the stage. Sam Rhee, Chairman and CIO, Endowus. Everett Leonidas, Head of APAC City Ventures. Oyi Chu, CEO, ADDX. And Chetan Karkanis, Senior Vice President and Head of Digital Strategy and Wealth Management for Asia Pacific, Franklin Templeton. Over to you, Joydeep.
Thank you.
You're welcome.
Can you hear me? Yeah, okay, great. Sorry, then I don't need this mic.
Yeah.
Pass this on to you.
I think we're all okay, right? Yeah.
So first of all...
the remnants of DPM.
First of all, thank you all for joining me on this panel, and I'm very much looking forward to asking you questions which transcend the presentation and the research, and also in some sense could either provide a little more color around some of what I described. But before I do that, I'd love for you to just maybe quickly introduce yourselves. I thought I would do that, but then I said I would be reading off your CV, which is not a very nice thing. So maybe something interesting about yourselves as well, beyond what you do. Maybe starting from you.
Oh, great.
Pleasure to be here. Thank you to the Endowus team. My name is Chetan Karkhanis. I'm SVP of Digital Strategy and Wealth Management for Asia APAC, responsible for our firm's innovation and commercialization around the digital fintech strategy for Asia. Maybe something interesting about me. You put me on the spot. I wasn't expecting that question. Let me just put it this way. I've been in Singapore for about 5 years. And it's really great to be back in a region which I believe is thriving. And really, gosh, something interesting. I love nasi lemak, so I'm glad to be back.
Oi, you need to beat that.
Oh no, that's going to be a tough one, nasi lemak. You threw a good one. My name is Oi. I'm the CEO of ADEX. I was for many, many years an investment banker, and maybe the more interesting thing is actually investment bankers are the most technologically unadvanced part of any bank. But decided 4 years ago that I would explore different opportunities. And so the opportunity with ADEX came up, and we can share a bit more about that journey a little bit later. But so I joined ADEX 4 years ago, really to start the commercialization of what is a blockchain-based alternative investment platform. I've been doing that for almost 5 years now, and very exciting, the journey, and actually very happy to be contributing to this thought piece by McKinsey.
Thank you, Oi. Everett?
Hi, my name's Everett. I look after City Ventures investments across APAC. I've been with the company for about 1.5 years. I've been in Singapore for 9 years. Had a few stints in other corporate venture capital funds in Singapore. I think what's interesting about me, I'm not an interesting person, but my career has been, as I'm a former investment banker, reformed and recovering still from this to this day. I worked in corporates, I worked in startups, I worked in nonprofit, and I worked in investments. So I think I have a holistic approach to thinking about opportunity in this space. City Ventures is more about this. City Ventures is a 12-year-old initiative inside of Citigroup corporate franchise, seeking to bring innovation inside of Citi as well as to our clients by investing in category, defining startups that are strategically important and aligned to our franchise globally.
Thank you, Everett. Sam, I guess you must have introduced yourself.
I haven't actually, but
here's your chance.
I need
but you need no introduction.
Co-founder, and I have multiple titles at Endowus. I call myself the Chief Intern Officer, so I do everything and anything that is necessary. Fun fact, interesting fact, I guess that I put this panel together, so these are all my friends. But most important thing is that Oi, when she was sharing that she was moving from investment banking to ADEX, we had a conversation, and I hope that ADEX is appreciative because I had a hand in her leaving and joining ADEX. Yeah,
that is true.
Thank you, Sam. So let me kick this off maybe with Oi, since you've been a veteran of investment banking with management in some of the largest firms. How do you see the wealth tech space, and how do you see the evolution of wealth tech in the context of the broader wealth management industry?
Yeah, that's a very interesting question. I always take this opportunity to reflect a little bit on my career, my history, what happened. And as I mentioned, I've been in capital markets for about more than 25 years now. And in those days, in the beginning of those days, which was one of the biggest asset classes to be formed within the world, and certainly in Singapore, were the REITs, right? And so in those early days, I was very involved in IPO, structuring, distribution. And I remember in those days, you had to pick up a copy of the prospectus, right? If you're a retail shareholder, you had to take out the form, right at the back of the prospectus, you had to fill it out, piece by piece, write your name, your IC, your bank account numbers, and you had to submit that to the branch of the bank. And I'm just sort of, thinking that, and in those days we're like, we have to go and collect all the forms, and then you have to submit, and then, it took days for that to happen, right? And I think we've evolved so much from there. It went from that to ATMs, and of course, right after that, I think was really the Web 2.0 version of finance, which was really banking and banking becoming digital. So wealth tech really has only come about probably in the last decade or so, partly because the stock market was presumably one of the biggest investments for any of the retail shareholders, but I think over the last 10 years, the opportunities, the asset classes have shifted so dramatically across, funds, fund managers, active managers, passive managers, the stock exchange directly, and then now alternatives that you're starting to see wealth tech really accelerate in its evolution. I think part of that is also just the observation. I mean, Minister Heng, who is here, I saw Sob, who's going to speak later on, really is about MAS encouraging and developing fintechs in Singapore. And I think wealth tech is a big part of that. And we are just, I think, right at the beginning of that. It took e-commerce, banking about 20 years to really develop. So I think we're probably in our first half of wealth tech development around this part of the world.
Thank you, Rhee. And maybe Sam, I could then come to you. Endowus has had an amazing journey in the last 5 years. You've not just built something in Singapore, you've gone to Hong Kong, you've made acquisitions, you've scaled. You're not quite there, but you're well on your way there. Can you tell us a little bit about what have you learned as a part of this journey?
Okay, a lot of things, and we're still learning every day. I think that the wealth tech space is a very unique space, right? Some people throw in like trading platforms like Tiger, Moomoo, or Robinhood, or Futu. Some people even put crypto into the wealth tech space. But for us, I think wealth really is about how we secure the long term, right? Because wealth is a long-term problem and solution. You save money. So people talk about, high-income countries and how, Singapore is a rich country from an income perspective, but that's an annual cash flow thing, right? Wealth is a accumulation thing. So countries accumulate wealth over the long term. And so it's important for us to do the right thing in saving and building wealth, and then investing it really well. So stewarding that is really important. And that's why, we're really focused on the long-term stuff. So no trading, no single stocks or single bonds. We actually have no exchange-listed products because we want to help individuals change behavior in positioning their wealth for the long term. Because short-term volatility normally makes us react in the wrong way. And so what we've built is really technology around solving that core wealth problem of building wealth over the long term, going after the long-term liabilities that individuals have, like retirement and pension, and everything in between. And so I think what we've learned is that, look, what works for us, and this was the vision from the beginning, is to really envision a full-service business. So I think, Joydeep, you shared a lot of developed market examples. So a lot of those companies I know, I've invested or I've met the founders in the past. But a lot of the wealth tech space in the US developed was a very narrow space. So they only did ETFs. So they only did very passive investing, and the value add of that is very little. So Endowus has always envisioned a full-service platform, and as you alluded to, we actually have everything from like short-term cash, money market funds, passive low-cost index funds that we brought into Singapore, all the way to private equity, multi-strategy hedge funds, institutional quality stuff. And then also, it has to be holistic. So managing your CPF, your SRS, and your cash, all of your source of funds in Singapore is critically important for long-term success. So I think those are some of the things, but the really difficult thing, and I think all you should sympathize, is that direct-to-consumer businesses are a very costly business model, especially in wealth. So customer acquisition cost and building scale, as you said, is very difficult, especially here in Asia, because unlike the US, it's not one homogeneous market, it's a fragmented market. Each market requires different regulations, different licensing, different products, different partners to execute your strategy. And so it's a very difficult thing to build scale. So those are some of the learnings that we've had, and I think building a full-service technology-led digital solution that approaches wealth from a holistic perspective, we feel is the right model.
Oh, thank you, Sam. And maybe I go to you, Chetan, next for a different view, right? You're part of a large organization. You also have a manufacturer lens where you're trying to move to a more customer-centric model. leveraging digital and technology. You're also working with a number of wealth techs, right, to think about your broader ecosystem. So tell us a little bit about how do you see the landscape, and also go back to the question that lady asked earlier about where do you see incumbents and newer wealth tech players? How do you see that game playing out?
Yeah, both are great questions, and thank you for that. By the way, I love the report. I did a quick breeze through this morning, and I think a lot of the rationale for what Franklin Templeton is trying to do as a traditional asset manager kind of aligns with the kind of themes you've mentioned in that report. So I'll explain to you why is a traditional asset manager like Franklin Templeton really in the wealth tech space, and what are we trying to do? Well, if you look 10 years ago, the headlines were all about Google, Facebook, Alphabet, Apple. They're all going to disrupt the asset management and wealth management industry. The traditional incumbents have no place to play. That's really not turned out to be the case. However, technology and digital, and that digital experience, still has a vital role to play in the distribution as well as the servicing of client expectations. We're also dealing with a huge population of digital natives that is soon to inherit. You look at any report, it could be trillions of assets, dollars of assets over the next 30, 40 years. So how do you actually cater for the future, not just what the clients of today are? And that's exactly what Franklin Templeton is trying to do. And I'll explain three basic pillars of what we're trying to do. One is looking at the digital channel as a source of engagement and distribution. So how do you help B2C players, how do you help B2B players, whether they're incumbents or whether they're next-gen players, with tools, engines, things that can help with personalization and really helping the client get a better outcome. That's why we're all here, to help the end client get a better outcome for their goals, whether it is through personalized goals-based planning or it's through custom indexing. We're actually trying to be a tech player and innovate along the cycle of the tech life cycle itself. The second place is, I think OE will appreciate this, in the field of tokenization and alternatives, we have to be able to offer clients a better and more accessible way of reaching. You're really dealing with a product that's 80 years old. Think about it. 40 Act came out in 1940. It's an 85-year-old product at this point. Think about the ways you can actually disrupt that using blockchain, not Bitcoin, but blockchain as a fundamental technology. And we've actually already done this in the US with our Benji token, which operates on the Stellar and Polygon Polygon chains. And watch this space for more. I mean, we're approaching the Singapore FinTech Festival, so we'll soon have announcements there as well. And the third bit of it is, again, technology related, but what is a core asset that investment managers have? It's people. It's human minds and it's people. But there's lots of technology around there around AI, data analytics, machine learning that can be leveraged at the core processes of what we're trying to deliver as value. So I think if you just dissect it according to those three main pillars, a traditional asset manager, and I think we're among good company of other peers who are trying to do the same, but we need to continue innovating so that we're not seen as dinosaurs, 20, 30, 40 years out from here.
Oh, thank you, Chetan. That's really insightful. Maybe I'll move to the investor lens. And Everett, you saw me describing the fall in available investor money towards fintech, considerable fall in that. How do you see, what's your outlook? Also, how do you look at wealth tech players in the context of time horizon for investment given profitability? How do you think about the category itself relative to the others? It'd be great to hear your thoughts on some of this.
Yeah, so we look at ourselves as being a strategic investor and a bit more a patient outlook on how the markets develop. And so the way we invest is to really with the client service orientation. So we're a bank, a Citigroup, among other things, and banks have a intimate relationship with wealth, as large amounts of retail wealth are stored in banks, and so it's important to deliver on client expectations and provide elevated customer satisfaction across the board. And so we want to invest in companies that can provide our clients improved access, higher levels of choice, and elevated user experience as well. And so we're investing in for that long-term outcome with higher share of wealth with Citigroup. So in terms of the funding outlook, we believe that venture investment will still happen in the wealth tech space. we're always looking out for, and we always have been looking out for category-defining participants in solutions that have durable business models, large target addressable markets, and believable moats, like realistic moats that provide them competitive differentiation and competitive advantage. Platforms-oriented approach is a typical investment thesis for venture capital because that provides exponential outcome. And we still believe that exists in the wealth tech space, and we'll continue to find great startups that are doing that worldwide, but definitely in APAC.
Okay, thank you, Everett. Maybe one question to OE before I throw open questions to the audience. I'm very curious as you look at your model and how do you kind of support issuers, right? As you think about their investor base to find funds, how do you create that platform? What is your own approach to that?
Yeah, that's an interesting one because today fundraising is a very challenging market, right? So we do see a lot of projects come to speak to us to expand distribution. The first thing I would say is it's not like digitizing it or tokenizing it. It's not like putting lipstick on a pig, right? I mean, I can't make a terrible investment sell just because it's tokenized. So I think the first thing my team has learned is to really be quite critical about that, what that project is, or whether it's a fund or a company or a project financing. But actually, more importantly, which actually we spend more of our time, is what is the right investment. And we did not in this journey expect markets to be COVID, and then it was good, and then it was bad, and it's sort of. And actually, we also realized over time that the right project is the different, sort of different folks for different strokes for different folks. Today we see, in 2021, private equity was very popular. In 2023, actually, private credit is very popular, right? So I think having the platform actually then adjust to those choices became quite important to us, and that helps us, and that's helped by really we capture the data. Obviously, we have a large enough number of investors on our platform. We then sort of see the trends changing, right? Because we always try to have a shelf of different types of products across the different risk curves. We start to see patterns, right? We start to see people, investing more and more in a certain type of product. And then we're like, okay, how do we double click on that? Because it feels like the risk appetite has changed for this type of investor. I think over time, as we get bigger and more of that, I think we'll be able to be better at that. And then we can help issuers be more specific. Right? We can be much more targeted with, hey, we should be looking at, for example, corporates who have enterprise financing needs. Today is a good place to do short-term paper on platforms because investors are looking for short-term returns with the yield. So with that, we can better and be more precise with the type of demand, the size of the demand, and therefore be much more accurate when we work with issuers, whether they're large investors or small investors. We also do a lot of marketing webinars, so we do get a lot of soft feedback as well. And I think that's something that complements what is the hard data. And with that, we actually try and anticipate or predict what might be shifts in trends. I mean, for example, next year, how do we even approach 2024, right? And hopefully but I think what's quite good with us is we have a very powerful relationship network with a number of GPs and corporates. And so partnering them and finding the right time and the right opportunity to issue has, I think, worked relatively well for us.
Thank you, Ovi. And we have a few minutes left, so I have some questions from the audience. So maybe the first one I target to you, Sam, because you're the only one who can answer this.
Okay.
Which is, how does a firm like Endowus remain successful in this highly concentrated space, and how does it remain competitive?
Yeah, great question. I think it's related to how maybe Endowus is differentiated in providing the services that we provide to our clients. And I think we had prepared some questions, and one of the questions that was given to me was, how are we different from the traditional platforms like banks? or iFast, Fund Supermart, or because we touch multiple different segments of the market. And I think the first one is that, look, traditional channels have been much more product-focused or product-led, whereas what we're trying to achieve is an advice-led kind of solution and service. So we focus on the client and what their needs are, what their views are, what their goal is, rather than focus on a singular fund that we're trying to push, right, which is very product-led. The second thing is that I think that, technology enables a lot of things. So we can embed financial literacy education. We can directly answer questions from our client base on the app. Literally every month we have like CIO questions, Ask Sam kind of questions, and we embed it into the app experience. Our team does a fantastic job with that. So we can embed advice, education into the experience of the client. And the most important thing is that what we focus on, as we say, is advice, access, and cost. The three important pillars of success in wealth. And so I touched on advice, but access is critically important. And that's, I guess OE also is in that space as well of providing and democratizing access. And so that's really important, right? How can we get higher yielding money market funds that give you 5.5%? How can we get the lowest cost passive index fund into Singapore? We have that at 5 basis points, cheaper than any fund that existed in Singapore. Like, how do we get the best-in-class private equity or multi-strategy funds into the hands of individuals at lower minimums? Previously, private banks would make you put in 5 million. You can buy it for 100,000 in Endowus, at the lowest cost. So, and the final piece is cost, right? So it's critically important because every, beeps, every 10 basis points, 1% that you save on cost is directly improving your returns without taking any additional risk. So reducing cost at every layer is critically important. So we really focus on advice, access, and cost. And in every area, I think we remain competitive versus what other incumbent service providers provide. And that's why I think we've been able to succeed in scaling the business this way. Yeah.
Thank you. Thank you for sharing that, Sam. I have one more question, which I think a few more questions, but this one maybe I'll pass to you, Chetan. And the question is that if you think about adoption of wealth tech in private banks, asset management companies, wealth management companies, how do you assess the current rate of adoption among the different incumbents?
That's a great question. And I'll set it historically, just my background. I've been in the industry for about 25 years, 20 years in the US, 5 in Asia, although I lived in Indonesia in my childhood. So it's good to be back, like I said. Look, I think where Asia stands today across D2C, B2B to B2B2C or B2B to IFAs, for instance, I think there's generally, we're about 5 to 10 years behind the rate of adoption, maybe even more depending on which country you're in. Singapore and Hong Kong probably not as far behind. Places like India, China, Indonesia, quite far behind, at least 20 years. I'll give you a simple example, anecdotally. When I was a Schwab customer, I still am, 25 years later, they didn't have internal rate of return, they didn't have gain loss, they didn't have any sort of portfolio analytics or next best action. Okay? The difference between the US market and Asia is the disintermediation of the advisory market. And I think I may have, yep, okay, I'm back. Is the disintermediation of the advisory market. And in the US, you have 300,000 advisors, half of which are independent RIAs. In Asia, we all know about 80 to 90% is all intermediated, which gives folks like Endowus a brilliant opportunity to disrupt. But the challenge is, I think the rate of adoption within the banks, the incumbents, within the independent platforms is still far behind from both an access as well as the analytical tools that they use today. Simple things like, for example, one of the things we have been focused on is a goals optimization engine using dynamic programming. It's quite popular in the US. Here we get pushback because I don't think both the investors nor the intermediaries are quite there yet in terms of understanding how dynamic personalization should work and could work. places like India, which is a huge market right now, you're still operating where the US was about 20 years ago. It's about product pushing. It's about transactional. You know, the average holding period in the Indian market is about 1 to 2 years for 80% of the trades that go through. That's because of the lack of investor awareness, but also the lack of the intermediary awareness to guide clients to better outcomes and manage them through better portfolio analytics, better portfolio tools. So I see the glass as half, well, optimistically. I'm optimistic. So where I do see is tremendous opportunity in Asia to adopt these portfolio analytical tools, to come up the cycle so that we're going from version 1.0 to version 2.0 over the next 5 to 10 years. And that's across D2C platforms as well as B2B platforms. And I didn't completely answer a question before, but I think the reason, in Asia, incumbents need to recognize that their regulatory protection is only going to last for so long. Disruption will happen as a natural consequence of the trends that investors seek, and more I see it, at least if you use Singapore as a microcosm, digitally savvy natives are going to adopt things that give them access to better information and better outcomes. So I'll leave it at that, but I do think there's a lot of opportunity ahead.
And you do see a lot of disruption ahead, therefore.
I'm still hopeful, yes.
Could I opine on that too?
Yeah, absolutely.
Is that the investor and the advisor experience with wealth and investing is typically at the user interface level. And there's a suite of technologies in the back end that we just don't see as individuals, that some are provided by incumbents and some are provided by fintechs. And we look at infrastructure being a very important enabler for not just regulatory, but execution, for product selection and access and other services. So there's a lot of things that happen behind the scenes that are very provocative that help bring the whole digital experience and transformation forward.
Maybe stay with that, then maybe I'll ask you, actually any of you can answer this question, or at least we'll have a point of view on this question, which is any thoughts why platforms like Money Owl and Grab have discontinued the financial and investment offerings?
Oh, sensitive topic. Anybody
I can
offer?
go ahead.
No,
go ahead.
You see the most
this is kind of a controversial question to ask on the stage, but
Peyton's willing.
No, so I think that it's every startup and every proposition, whether it's a new initiative or a legacy one, has to find product market fit and continues to deliver on client expectations and have a sustainable model for the future. I mean, I can't comment on what happened with anyone else, but when I advise anyone looking at starting a business or starting a feature or launching a feature or a new product line, it's think about the end customer and how you can continue to deliver on those expectations, meet and exceed and deliver something magical and delightful to your customers, and they'll continue to come back to you.
Chetan, you were going to say something.
Much along those same lines, Everett, so I completely comply. I agree. I think one other point is saturation. I think if you're not very clear on the value proposition, and I think Endowus has laid out a very clear value proposition, access, advice, and fees, costs, right? You have to win across all three. If you're not winning, then in a market like Singapore, given this population size, the saturation effects can happen much quicker than in a market like the US, where you have hundreds of these. They're still existing, but it's just going to take longer to scale up. So it's just a difference of saturation point.
No, thank you.
Yeah.
I think we are exactly on time. So firstly, I wanted to thank each of you for your really insightful thoughts and for sharing quite openly both easy as well as slightly difficult questions. So thank you very much.
And as a close, can I say one word? Because I think, I think it was a few years ago during COVID, Joydeep and Vishal and the McKinsey team published a report on the wealth management industry and technology, WealthTech. And Greg and I both read it and we thought it was very insightful. And that was one of the reasons why we engaged Joydeep and Vishal and Serena and the McKinsey team this year to, work on this Asia Pacific WealthTech report together. And they've been amazing partners and exceptional, and really excited to have you join us as a knowledge partner this year.
No, thank you. Thank you very much. It was our pleasure. I would say that.
And please download the report and read it. Yeah, fantastic.
But I think, the three words which I think advise, access and cost. I mean, that's it, right? That's all we need to take away. So thank you.
Thank you.
Thank you once again to Joydeep and our panelists for a super informative discussion on the transformative impact of wealth tech in reshaping financial services for a new generation of investors. Thank you all very much. A few takeaways, of course: advice-led solutions always work. Financial literacy also always works. Access makes it totally democratic, and tech makes it simple, maybe even profound, and it disrupts the status quo. We are now at our last panel for the afternoon, the role of AI and deep tech in wealth management. A round of applause, please, as I introduce our panelists. Swapnendu Mohanty, Chief FinTech Officer, MAS. Julie, Chief Technology Officer, Endowus. Kumaran Kaliaperumal, Chief Data and AI Officer, Microsoft APAC. And the moderator for this session is Stephanie Magnus. Come on up, guys. Principal at Baker McKenzie, who'll delve into the role of AI and deep tech in wealth management. Over to you, Stephanie.
Okay.
All right, thank you very much for being here today and joining us for the last panel of this afternoon. And really pleased to be with my fellow panelists, Kumaran from Microsoft, Julie, the CTO from Endowus, and of course Swapnendu from MAS. So we're going to change tacks a little bit, right, to talk a little bit about the role of deep tech and AI in wealth management. And if I can just start off, right, and just kick this off, if I could ask Kumaran just to scene set a little bit for us, right? What really is AI? And we've been hearing about Gen AI, right? Is there a difference between traditional AI and Gen AI? Maybe if you could just set the scene.
Sure. Yeah, no, totally. I think we need to take a step back and understand that this is not totally new when we talk about AI. AI is all about getting a model, a machine to kind of do some sort of decision making for you. I think if you go even slightly narrower and you kind of do a subset, if that bigger Venn diagram is AI, and within that bubble you talk about what traditional machine learning or classical machine learning, which is the background that I come from, you talk about whether an individual can buy a loan, or can buy a car, can he even get a loan, etc. There's kind of like a binary output or do regression. So that's kind of like classical machine learning. And in that particular field, you're talking about data that comes in and then the output, right? It's very, very structured. It's very limited. It's like tables, rows, very specific, right? Then, if you move further along, you talk about deep learning, right? And this is where you're talking about, also having a very structured output, but the data that you get in is actually fairly unstructured. You're talking about images, you're talking about voice, you're talking about a lot of text, right? And now what we're seeing is Gen AI. And Gen AI is the reason why it's kind of like a step change is because your output, right, what you actually get back as a user is very varied. It's not limited, right? Which means in the past where you had a lot of narrow models to do very narrow things, but any business process is a collection of individual processes, right? So the white space in between these processes was actually the biggest problem to solve for. And Gen AI kind of like breaks that down, and you're able to use this one model across the entire business process. So I hope that makes a bit more sense.
Yeah, thank you. Thanks very much. I think maybe over to you, Swapnendu. MAS has twin responsibilities, right? The responsibility of innovation, right? And looking at how AI can actually be used by financial services and financial institutions. And then the other responsibility of regulation. And I just wanted us to maybe talk a little bit first about what sort of opportunities you see, for the usage of AI for financial institutions, and what do you think, some of the major challenges are?
Thanks for having me. This is the worst time to give a panel because I'm just watching the World Cricket and Australia is doing marvelous. If you are an Australian fan, you should watch the cricket right now. It's an amazing cricket match going. Anyway, so that's kind of is occupying 80% of mind, the whole cricket thing. Question, regulation. What can we do? Well, MAS has been over investing on AI for last 3-4 years in terms of policy choices. 3-4 years back, we started Project Veritas, and the intent was that we anticipated that this was going to be quite a mainstream technology, and instead of waiting for things to go out of control, we started Veritas, which is essentially talking about how do we create a responsible AI narrative in Singapore. And just before Veritas was launched, we had the FEED principles out there. And the question for us that, okay, as a regulator, you can ask industry to be fair, ethical, accountable, and transparent, but how do you do it in a software world? So instead of asking banks to follow a principle, we thought we should indulge together and start coding and figure out how to do it. It is a 3-year journey for us, and we have done 4 use cases. And we have put in the public domain an open source code where you can look at how this code has been developed to allow software companies, banks themselves deploying AI to able to ensure, at least reasonably ensure a framework for them to ensure these are conforming to the FEED principles. And then came the Gen AI piece. And we again proactively got into that space, and we started a project called MindForge. And it is going to follow the same path. It's a bit of a tactical shift there, primarily because we still don't understand that well. So we are going in a use case based model there. We have done a co-pilot program out there, but what we are looking at from now going forward, that when I think the kind of use case we have today. We don't see a dramatic transformation taking place in banks right now. The focus banks are having in AI are marginal in terms of increasing their own efficiency gain. And I think while it's good to talk about that we can do AI, a lot of transformation, there's no real shift in terms of the core technology infrastructure. In fact, I asked a few months back as a head of AI for a large multinational bank, how much tech budget you have for AI? He says hardly anything. So the tech budget allocation for financial sector on AI is actually very small. And most of the AI, they're already either using it as part of the software services they're getting for very foundational investment in terms of technology infrastructure is very low there. So I think there's still a long way to go. But as a regulator, we will push ourselves to see how much you can extract from this tech opportunity. But unlike other regulators in Singapore, we do things differently. We will work and code together to get it right.
Okay, that's really good. So that's really interesting, actually. If you're talking about AI, and I think it's nascent, right? In the sense that financial institutions are starting to use technology, but you're not seeing that big step change or that big transformation. And in a way, I guess that's good because they're being very responsible.
I don't know if they're responsible. That's an easy way of saying that don't not do anything. So sometimes that could be other reasons. I don't know.
Okay. You also mentioned this word that's been buzzing around, and that's co-piloting.
Yes.
Right? And is that something that you think you'll see a little bit more of?
Yeah, we'll see, and I think it's important for regulators to be also demonstrate this intent of co-piloting themselves. And one of the use cases we are picking up is our own space, which is regulatory. How can we seize a co-pilot which can allow us to industry to frame a response to a regulatory stance? So yes, you will see more of co-pilot as a safer way, but I still believe the tech budget or capital allocation on AI is not adequate enough to really push the transformation. I don't know, I'm open to getting criticized on this. Somebody can question me from the audience on that significant budget allocation on AI, is it really true? I have not seen myself.
That'll be interesting. Maybe if you could provide some feedback on Slido, and then we'll see, whether this is indeed true. But Julie may be unable to answer that question, right? As a financial services firm, are you actually, do you actually see a change, right, in terms of the way technology is
Do you have the budget to do the change?
Yeah, and maybe you can help us answer that, right? What are you seeing in the market?
I actually see a lot of excitement from CTOs, but he's right. I mean, it's actually not that easy to get buy-in from the business stakeholders, because it's usually things like this. You have to showcase that it really brings a real value add to the organization, and that there has to be at least a couple of production use cases that are really delivering values, and a lot of people in the industry haven't seen that yet. So, and also there's a lot of fears around Gen AI, hallucinate, things like that are still, industry I think is still, learning the Gen AI in overall. And financial industry is pretty sensitive industry for Gen AI. I mean, we are regulated, and we don't want to, we don't want to make mistake of, using AI to give some wrong advice to our customers, for example. So it is true that budget is we just had quite a bit of a budgeting discussion with CFO this week and last week. So
I'm just helping.
Yeah.
Go for it.
So a lot of CTOs what they are trying to do, including myself, is really develop something on the side, because the difference between Gen AI and the previous AI and machine learning, as Kumara mentioned, Gen AI is easier to use and easier to understand its output. So we want to develop some use cases and showcase to the business so that we get conviction, and then therefore we get budget.
Okay.
Yeah.
So I think you've been thinking about it and discussing it. Where will you best be able to deploy AI? Is it in the customer journey, in the front end? Right. Where can you integrate AI into your whole process?
So that's a really good question. And when I first started, as I started using ChatGPT myself, I actually some sense of urgency developed in myself, and I really wanted to try something with it for Endowus. And I thought that I could do one of the two things. One is we use it to boost our internal productivity, or we use it to develop some cool features to enhance our customer experiences. I thought it was actually a binary choice. You can't develop something that benefit both sides of the world. But then I had a lot of discussions and brainstorming with various teams at Endowus, and then we found this use case of with client experience team, where they're currently spending a lot of time answering questions from our customers about our platform that comes, and these messages are coming in various different channels, but primarily over WhatsApp. And when I first look at this list of questions in our database, I was two thoughts. I was oh wow, I feel somewhat sorry to our CX team that they need to spend a lot of time answering this question themselves. And then I was these are the questions that may not be so straightforward for our customers to find the answers just by browsing our web pages. But these are the questions that really, strictly speaking, don't really deserve human interactions. AI, as of today, can answer these questions quite easily with right guardrails. So we started developing a CX bot, which we will share with everyone later on. But then, to answer your question, I think, as long as you have a right guardrails, monitoring systems, and accountable person monitoring the interaction between the bot and your customers, actually, technology is quite ready to be presented to the customers.
Okay, thank you. So, there's a little bit of, you've heard Julie talk about CX bot. Please stay till the end of the panel. I think he's going to talk a little bit more about that. But you've talked about guardrails,
yes,
right? So maybe a question for Kumara, and I think, what strategies can businesses adopt, right, to effectively leverage AI while ensuring that there's regulatory compliance or guardrails and security?
Sure. And I'll get to that in just a bit. I think I just wanted to comment two things. One is, I think the amount of money that's spent on AI is relative, right? I would say as a percentage of total IT budget, I would say yes, it's still kind of drop in the ocean. But if you look at like in Japan, for example, and with the we have a mechanism to kind of deploy a lot of OpenAI compute power on the use cases that they want to do, and within the snap of a finger, they're willing to do it, right? Because that is that appetite, that those pain points are so real for this institutionalized financial institutions. But yes, as a percentage of how much they spend overall on IT, it's still very small. But I think that goes to first time, at least I've been in this space for a long time, but for the longest time, it has always been business use cases driving what the technology decision should be. But now what I'm seeing is the art of possible with Gen AI is just so huge that a lot of businesses are coming in there, business leaders are asking, what can this do? I'll give you a quick, maybe story or example, right? Credit risk. And everyone's like, look, credit risk models, we spend years and millions of dollars perfecting the best model so that, because it's lending, right? So we don't want to get that wrong. And everybody's like, look, Gen AI, no way, right? No way it can actually help you because you can't decide. You can't decide whether this person can get a loan or not. And that's totally true. But what about the inputs into your model, right? What about the data that actually goes into that model to decide eventually whether you get a loan or not? Today, we're so limited by the structured data that we have. What are the unstructured data? How do you actually pass through that data and build features, tag the data, look at the metadata so that you can input it into your model so you get a better outcome? So Gen AI can actually do that. Excuse me. And that's where we're seeing today when we look at a risk officer come into it and say, wow, I can now tag my data in a much more efficient way and get access to more swaths of data of that particular individual and feed it into my credit model, right? So I think that is now happening, and we're slowly seeing more and more demands on the IT budget to be channeled towards this kind of use cases. And on that part, with risk and guardrails and specifics, I think it's the classic, tale of people, process, technology. I think in terms of making sure that there are the right tools, the technology part, there's so many. There's open source, there's Fallon, and within Microsoft, we didn't just wake up one day and say that responsible AI is important, right? So there's been a lot of tools, even within our ecosystem. I understand that the board is being built on Azure. You have prompt flow. You have a lot of dashboards that are in place. So that's the tool part. I think we now partner. I think so we focus a lot on the enterprise, right? And the enterprise clients are coming to say, so how do you do it, Microsoft? So how do you build products that have these right guardrails in place? And the answer is also because we set up an Office of Responsible AI, right? And Natasha Crompton leads it in the US, but they roll up to our overall legal team. And we are now partnering with them to teach them, right? Teach them what it actually means to have the champions, to make sure that you engage in ethical practices even when it's partnership with data and so on and so forth. So there is like a proper end-to-end view of responsible AI, which is like people, process, and technology. And it's not just something that you put on a slide and it looks good. Like it's actually operationalized at scale within Microsoft, and I think we have the responsibility to share it with our partners and with our clients as well. So that's how we do it.
Okay, thank you. So you talk about responsible AI, and I'm looking at some of the questions here. And if I can sum up in one word, there is a question as to whether or not we can trust AI, okay? So some of the questions are, will customers really be willing to be served by AI, okay? What about consumer protection? Is there a risk of AI becoming self-aware? And really, at the end of the day, I think these are questions about, can I trust the usage, right? So what would you say? I think we are also all consumers here. What would you say to a consumer who's concerned about the usage of AI? Yeah.
Me?
Yeah.
Okay.
And this is a question for everyone, actually.
Okay.
Yeah.
Okay, I'll take a stab at this, right? I mean, this is a very, very tough one. But I would say to that consumer, like, you're right. I mean, you're right to be concerned. And I think trust is not about the AI application or the AI tool in and of itself and the model. It's actually the institution, right? It's the trust in the institution. So if you're saying, look, am I being served by this particular model? Am I getting recommendations? Like, who's actually doing it? Who's actually building that, right? And is that particular institution or enterprise engaging and being completely transparent? So I think we have, say, for example, 6 principles, right, that we are very transparent about. We have fairness. We have 6 principles that we outline, right? So if I was a consumer and I had concerns, which is fair, right, I can just look it up. Right? What does trust actually mean? What does responsible AI actually mean? It's a loaded term. Right? So if you break it down into these 6 components and you read it and you understand it, then you're more willing to engage in such a topic. Right? So I think that's where my mind space is always at. Once you get educated, once you understand it, I think consumers will be more willing to participate.
Yeah. And look where it's coming from.
I'm not sure that question is framed properly. I really don't care what technology Endowus use. My trust is with Endowus as a company.
Absolutely.
If whatever they're advising me, I trust Sam. If he does something wrong, I'm going to call him. I don't care about the AI or somebody sitting behind doing something for me. The responsible AI comes from a regulatory stance on Endowus. When they implement the technology, they've got to ensure that they've got to protect consumers' interest. If they cannot do it, bad luck for them.
Yeah.
But from consumer perspective, this is a moot point. They expect the most appropriate product for them at the cheapest price at the time they need it. If AI can help that process and get it to that level of expectation, I think consumers will be happy. They really don't care whether there's AI behind it. The person who should care are the institutions which are regulated. They better get it right.
Yeah, really, that's a really good point, right? So as a consumer, you look at whether you trust that financial institution to see whether or not, the product that they're delivering, they're responsible for that, right? And so you look at that, and I think that's a good point, in terms of rather than thinking about do we really trust AI itself, right? I think, what you mentioned, Kumaran, about having an Office of Responsible AI. So when whatever you roll out, right, it's something that actually will be considered. Julie, how about from you?
For our CX bot project, we didn't start the project by writing a code. We actually started by writing a document. We came up with our own internal guidelines and framework on how we want to evaluate the performance and safety of any AI bot we're going to build in the future. And that framework was built on top of FIT principles from MAS. And in that guidelines, it states how we will evaluate. So we came up with like 65 questions we'll ask against any bot we're going to develop, like that tests against its sensitivity against political question, gender question, but basically everything that's stated in FIT principle. And also we agreed on like how we're going to monitor the bot's responses. So we develop our in-house system that can monitor in real-time interaction between a bot and a customer. So we started by building the guardrail. We didn't start by building the bot itself. And in terms of earning customers' trust, I think it's really up to how we handle this as an organization is spot on. Like, it's not really about whether customers will put in their trust in the technology that's behind the AI, like which is like OpenAI or GPT-4. It's really like their trust has to be with the implementator, which is Endowus in this case. Yeah.
Okay. Would you like to introduce your the CX bot?
Yeah, so it's a...
Is a FIT principle compliant?
Yeah, we think so. Our chief compliance officer is okay with it.
Okay.
So it's currently in beta mode. Please scan this QR code. It's So our client experience board is currently integrated to WhatsApp, our WhatsApp channel. It's in beta testing mode. We're actively testing it and building it. We've been internally testing it for a while. We think it's okay to open it today to just strictly to this group. But we need more feedbacks for us to be able to go live with it. So we are planning to go live with it in a week or two. Hopefully there's no crazy hallucination happening or anything. And please be assured, we're not connected to public open AI. We have our own private OpenAI cloud running under Azure. So this morning, OpenAI had a 4-hour system outage. Our bots were not impacted by it at all because we are running on Microsoft Azure. So please send us feedbacks.
I haven't started using it now.
It's safe.
Yeah, try to jailbreak it.
It's on Microsoft. It's safe.
Yeah. Thank you. Yeah. Please help us improve the bots. Yeah.
Okay, and I guess feedback is very important.
Very
right?
important. Yeah. I like last week. I thought it was pretty strong already, and I asked my wife to test it, and in 2 minutes she jailbroke it. Like,
wow.
Yeah, I was like, how?
That's why you need a wife.
Yeah.
Okay, I think we're almost at time, but I just wanted maybe to sum it up a little bit, right? I think there is, of course, a lot of interest in AI, and I think here in Singapore and the MAS, certainly back in 2018 has already established the FEED principles, and with the Veritas project. There's a question as to whether it's going to be a step change or whether it's going to be incremental. But I think my panelists will all agree it's something that definitely financial institutions will consider on a going forward basis. And for here as consumers, I see that you've trusted Julie here and trying out the CX bot. So that's great, right? So again, I think having trust in the institutions that you deal with, I think that's a really important point to take away as well. With that, I want to thank you and thank my panelists as well. Thank you.
Thank you.
Welcome.
Thank you very much to our esteemed panel, our fantastic moderator. Thank you so much for rounding off this afternoon for us. I think it's wise for all of us to remember that the role of AI and deep tech is to always be responsibly wielded and regulated by humans who actually walk the talk. Ladies and gentlemen, we have come to the end of our wonderful session this afternoon. We really hope that you've had a great time with us and have really felt that you've had some thoughtful insights and some new information as well. Before we head outside for the cocktail reception sponsored by Carlyle, I would like to invite Endowus co-founder, chairman, and CIO, so many things, Samuel. I'm so tongue-tied now. To Samuel on stage to close off today's session, if you would, please.
Just Sam is good,
Sam,
as you know.
Samuel Rhee.
No, just Sam. First of all, thank you so much, everybody, for joining us today in this conference. What's most important to us is obviously our clients, but really the community that we're building here. It's so critically important to the future of wealth here in Singapore and in Hong Kong. Many people are joining us virtually from Hong Kong as well, that we build the right ecosystems that will strengthen the foundation of wealth technology and wealth management. And all of you are so critically important in building that foundation and ecosystem in the right way. One of our most important partners that I want to introduce is Carlyle, who have been very gracious to join us. Tracy's here representing Carlyle. And we've shared about how we are excited about the space of alternatives and private markets. And Carlyle is one of our most important partners in this space. So without further ado, and to not keep you from your drinks, please stay for the drinks. But Tracy, over to you. Thank you.
Thank you, Sam. Thank you, the Endowus team. I guess just to set the scene before our sponsor drinks, just to share a few observations, right? People say the outlook is uncertain. I don't agree because that's a cop-out. There has been no time and there will be no time where there is certainty, for example, around geopolitics, asset pricing, risk appetite, and therefore the best portfolio. Lending is a centuries-old undertaking. Borrowers enable a large enterprise with more optimal returns to owners, with lower average cost of capital than unlevered firms. Layers of debt in the capital stack enable good business and financial managers to stream cash flow and manage a wider range of lenders, and therefore allowing them to grow the business. Traditional lenders have been banks who have relied on their ability to raise low cost of capital via deposit activities for them to intermediate those to borrowers and manage the results in ALM and default risk. More recently, banks have been supplanted to a small extent by what we call private lenders, often with special purpose funds operating with lower regulatory and capital impulse and providing a more see-through capital portfolio than the equity and bond holders when you invest in a bank. Some of this growth has been spurred by technical weaknesses in the banking system. It started in Europe and is now spreading in the US. This has led banks to hold less capital on their balance sheet, shrink their balance sheet, as well as to merge or fail in some instances. All of these are providing tailwinds to alternative financial sources of financing. Private lenders are also able to build more focused portfolio, enabling smart investor to pick your capital stack, geography, and even industry to some extent. Compare this to buying the bonds of a big bank in the old days, which is in aggregate the same thing, the same investment, but behind the walls of a bank. It is the more detailed, tailored, and specific approach that we create portfolio that are good fit for wealth clients. We can generate a tailored mix of cash flow and capital return that help wealth managers to build. The speed of tech and AI innovations approach the breadth of investment opportunities and the growing need of our client, convergence of social and financial platform definitely provide all of us an opportunity to deliver better outcome for our clients. We see the advances of WealthTech as a good complement to our portfolio and product approaches, as in our partnership with Endowus. And I would welcome the opportunity to discuss this further with you all. Well, to finish, there is always a saying, how many WealthTech programmers and designers does it take to change a light globe? The answer is none, because at the end of the day, it's a hardware problem. And on behalf of Carlyle Global Credit, enjoy the drinks. Thank you.
It's free flow, guys. Thank you, Tracy, for the free flow.
Important.
Thank you very much, Sam. Thank you, Tracy. Ladies and gentlemen, today's event has come to an official end. We'd like to extend our heartfelt gratitude to each and every one of you for joining us and being with us today. And of course, to those who have joined us virtually, thank you so much for being with us all this time, for being an integral part of the success of the Endowus WealthTech Conference. Your presence and engagement has truly made the event a remarkable one. Don't forget, of course, day 2 is tomorrow. If you have actually signed up for it, same time, same place, right here at 9:30 a.m. My name is Anita Kapoor. It's been a pleasure to be your host. Enjoy the drinks. Have a wonderful night ahead. Thank you.